to remind the presenters about time. I apologize for that in advance. All right, thank you everyone. And I hand over to our first presenter, Zahi Ben David from Ohio State. He will talk to us about exporting pollution. Where do multinational firms emit CO2? Zahi, the floor is yours.
All right, thank you so much. It's early morning here on a Sunday in Columbus, Ohio. So greetings to everybody. Okay, so our paper is called Exporting Pollution. Where do multinational firms emit CO2? And this is joint work with Yijin Zhang, who is currently in the audience, I believe. Stephanie might be also here, and Michael V from Erasmus and Oxford. All right, and I should mention also that the views here are not reflecting Michael's employer, which is a Hermes investment company. All right, so let me just jump in. Oh, I should share my screen, I guess. It's early in Ohio, as I said. All right, so let me see whether this works. Works? You guys see? All right, fantastic.
Perfect.
So just take a moment to be impressed by the background here. All right. Okay. So the paper is about carbon leakage by multinational firms. So just to kind of set the stage a bit, different countries have different environmental policies, and what we will be interested in doing here is looking at firms that are multinational, meaning that they have operations across different countries, and explore where their CO2 emissions are. Now, why multinationals? Well, multinationals are the largest economic players in terms of corporations. If you look at, just as an example, in 2017, 50% of the cross-border investment by multinationals was about 50% of GDP of OECD countries. So this is substantial. They also have existing infrastructure, so responding could be just easier for them. You know, if you're just a local firm, you know, doing something with your pollution activities is more difficult. For them, it's easier to shift if they wanted to shift activities. It's cheaper, and finally, their activities are easy to observe. These are oftentimes, or most times, public companies. They report their emissions, as I will discuss in a few moments. Now, so what do we kind of going kind of more deeply into the paper? We're going to use a novel panel data set that reports at the level of firm, country, year their CO2 emissions. So for each country, think about a country that works in firm that operates in 10 different countries. We will know in each country how much they emit, and also the emission is going to be, the CO2 emission is going to be on several categories, as I will discuss in a few moments. And basically, we'll try to answer how important are the home versus foreign environmental policies. Now, I'll preempt some of my discussants' comments right off the bat. This is not about randomized experiment or any clever identification in terms of a rule change, or we're going to have just slightly flavor of this, but it's going to be more a broad brush mapping. I mean, when we got access to the data, we kind of said, Sometimes, when you look at these rule changes, you see kind of maybe the trees, but you don't see the wood. And we were interested in kind of just broad brush mapping, just, is there any correlation, or are they just to understand where the big picture in pollution? Maybe we could say something as economists there. So just to kind of what we're going to look at, we're going to look at push versus pull. This is going to be, I think, one of the more interesting results here in terms of our is stricter environmental policy at home pushes you away, or are there like enticing countries that you want to emit there, and their lax environmental policy actually pull you to their country? So we'll talk about supply chains, and maybe we'll be able to say something about corporate governance and industry characteristics. But as you will see, there are a few caveats there. All right. So just to kind of quickly summarize the findings, I think that there is substantial evidence of carbon leakage, meaning that firms that are headquarters in countries with strict policies actually pollute less at home, at their home country, more abroad. And there is also outsourcing. There is evidence, and again, it's going to be a bit caveated, but there is evidence of outsourcing polluting activities along the upstream, basically to suppliers. And pollution abroad, called exporting pollution, is going to be higher when there is a bigger environmental policy gap between the home country and the foreign country. We also find that when you have a stricter domestic environmental policy, firms pollute less in total, but this effect seems to be kind of minor, and again, it's going to be a bit caveated, this result. We'll talk about push versus pull. So strict domestic policies seem to push away pollution to other countries, as opposed to kind of pulling by foreign countries. If you think about third world countries, it's not. We don't see a lot of pulling by offering convenient policies for pollution, but rather it's the home country that push off. And finally, there might be some association, again, going to be caveated with about governance and pollution-intensive industries. But I should say, we don't find material results for pollution-intensive industries. Okay, let me start with the data. So we're going to have emission data per firm, per country, per year on 3 levels, or actually 2 levels, and the third one is going to be more. But the 2 levels are scope 1 and scope 2. Scope 1 are basically emissions being used directly by the firm. So the firm has manufacturing facilities. How much do they emit straight from these facilities? It includes also travel. It includes also any activities that the firm does. Scope 2 is the emission being done by the electrical and heating companies. If they use some third-party, well, most firms use third-party electricity, how much emission is done in this process. So these are kind of indirect energy being used to pollution that was done during this electricity. So it's going to be, for example, different firms will report different emissions if they used electricity coming from solar and wind power as opposed to fossil fuel, depending on their electricity supplier. And finally, so these 2 are going to be at the firm, country, year level. Finally, we know also for some of the firms, for about 40% of the firms, for a subset of the years, we have information about scope 3. Scope 3 is kind of going beyond it. It's basically about the inputs, about the emissions that were used in your inputs, about business travel, it's about commute, and all these kind of even more remote activities. We have information there only at the global level. So for each firm, we will know. So say Apple, we will know what's the total amount that they emitted in scope 3 in a particular year, but not broken down by the country. All right. So the data comes from a CDP carbon disclosure project. So these are basically voluntary questionnaires that are being sent to public firms. And the reason that public firms spend time and money responding to these and they try to make it accurate is because these are used by institutional investors. And this the CDP database is basically makes its living from selling this data to institutional investors who care about ESG. Some of the data is actually audited, and we have, as part of our robustness, we just run the main results for the audited subsample, and the results are very similar. Okay, so we have emissions to nearly 2,000 public firms across the globe. They are headquartered in 48 home countries, and they operate in over 200 foreign countries. My daughter yells there. אמא לא בבית. היא הלכה the survey, the years for the survey are 2008 to 2015. And we have information at the firm country year, as I mentioned, for scope 1 and scope 2. For about 40%, we have information for scope 3 at the global level, firm year, but only for 5 years. Now, there is another issue with scope 3. Scope 3 is less standardized, so firms seem to kind of include different things sometimes in scope 3. So the result that I'll show you with scope 3 have this caveat that we feel less confident about them, but you know, this is the best we have. So this is one kind of important data set that we use. The second component is the environmental regulation index that comes from the World Economic Forum. And basically it has two components. One is about stringency of environmental policies. And the second one is enforcement. We combine these both, they are highly correlated, as you can imagine. We combine them to a single score, which we call SEER. There's an acronym. And basically higher means stricter. So both, it's going to be a multiplication of these two individual scores. And just to get a kind of an idea about how the data looks, what you see here on the right are basically the average fraction of, these are kind of like our main result, the average fraction of foreign emissions out of your global emissions per country as a function of SEER. So what you could see is that on the left you have the low environmental policies. Firms that are headquarters in Russia, India, Turkey, China, Colombia, Thailand, etc., are emit CO2 more at home as opposed to abroad. As you move to the right, you get to the more OECD countries. You know, we can see there Japan, New Zealand, Finland, Germany. The US is also somewhere here. US is 4 only. So for these countries, they emit more abroad. Now, obviously, this is just summary statistics. In our regressions, we have controls for the for GDP, etc. I'll tell in a few moments, but the its relationship actually is conserved in regressions. I'm not sure whether this slide is optimistic or not. If you look at the difference in our environmental regulation score between 2008 and 2015, it's changed, but a bit. Okay. All right. So our first set of results, basically looking at basically the relation that I showed you in this chart. If we look at how much you emit, we're going to have different categories as you'll see in a moment. How much you emit as a function of your environmental regulation score at your home country. What we find is that firms that are headquartered in countries with strict environmental policy emit about 20% less, both scope 1 and scope 2. They emit much more, the effect is much larger, meaning they emit much less in their home countries, but emit much more in foreign countries. This is basically what you've seen in the univariate chart before. Okay. Now there are controls in the background. So basically, we control for the firm's size, the foreign asset shares in some of the. This variable is a bit missing, so in some of the regressions and some country home country variables like the GDP and GDP per capita growth. There are also industry and times year. Then we look at global emissions. So the question we're trying to ask here is whether there is an association between the environmental policies at home and your overall global emissions. And we find that firms that are well, actually, I showed you already that global emissions are lower by 20%. Sorry, it's too early here in Columbus, Ohio. So we'll try to ask the following question here in this analysis. We know what happens in scope 1, scope 2 that are kind of under the control. Scope 1 is directly under the control of the firm. Scope 2 is more is a direct input in a way, electricity, right? Scope 3 is about your suppliers, your business travel, or things that are kind of more remote. You have discretion, but it's somebody else is who pollutes. May not be under if I buy some inputs coming from a different country, it's not. Even if in my country there is a strict environmental policy, it's not going to be taken against by my own company. So the question is, what we're trying to ask is, do firms in strict countries with strict environmental policies outsource more these kind of activities? So as I told you before, scope 3 is available only at the global level and only for some of the firms. So the first thing that we do is we just repeat our earlier global emissions regression for this subset of firms for this subset of years. And what we find is that this is what you see here in the first column. For this subset of firms, they use less of scope 1 emissions, about 24%. Before it was 20%. So they emit less at home. Now the question is, do they substitute along the supply chain? So we look at scope 3, and there is a positive yet insignificant effect of substituting away. So they use slightly statistically indistinguishable than zero more pollution along the supply chain. When we combine scope 1 and scope 3, kind of asking, okay, overall, do they substitute their own activities with scope 3? We find that the global emissions for these firms is actually halved than what we would estimate or what would look like if we just looked at their direct activities. So it seems that there is a bit of pushing some of your emission or towards firms upstream the supply chain. Okay, so we try to take advantage of the fact that we see where they emit. So we're going to look at the gap between the environmental policies at home versus the entire globe or all other countries. So we're going to ask, are you going to emit more in abroad when the policy gap is bigger? And this is what we find. We find that firms are more likely to emit in foreign countries when the gap, the policy gap between the home and the foreign country is larger. We talk about a couple of economic mechanisms. The first one that I think is the most interesting and important is the push versus pull. So if you think about so far I've shown you associations, right? I mean, these were correlations. There is a good reason that there are some omitted variables that we haven't controlled for, and that's the nature of the data. Right, so these are associations. The question is, can we say a bit more about whether whether countries actually push firms out by? Is it the strict policy in the home country that pushes firms to pollute out, or are these foreign countries that actually pool, provide convenient environmental policies so that firms come to them, right? And you have in the environmental economic literature, the theoretical one, you have proposal for both mechanisms. So what we're going to do here is to use the Kawaja and Mian 2008 framework. So the idea is that because we have this interesting data structure of term, country, year, we can actually try and control for basically hold constant the policies of my my home country per year and ask, does the variation in foreign countries' policies matter for firms headquartered in my year, and vice versa for the foreign firms. So let me just show the results and hopefully it will be clearer. So what we're asking here, we're looking at the push effect. Do firms actually, do countries push away domestic firms to pollute elsewhere? And so here's what we do. We look at the left-hand side in these regressions is basically how much you emit in foreign countries. And we're going to have fixed effects for foreign country times year. Okay. So the variation is going to come, and we're going to control also for home country fixed effects. So the variation is going to come actually from variation over the years in your home country. Okay, so we're holding the home country fixed. We're holding all the foreign country times year fixed. So the variation comes from the variation here in the environmental policies at home actually come from time variation in your home country. And what we find is that as this variation, as the environmental policies at home increase, there is basically you send out more of your pollution outside. So this is what we call the push effect. When we look at the pull effect, we find no evidence. So the pull effect is going to be the reverse exercise. We're going to fix the home country and year policies and ask, does the time variation in foreign countries, in the policies of foreign countries, actually matter for firms that are housed in the home country? And we find basically no effect. It seems that what's going on here is that it's about the push. We also look at governance, which is conference. What we find is that there is a negative association. I should say, how do we measure governance? We basically use what institutional investors use. It's a Thomson Reuters Asset4 database. And we use just the overall governance score, which basically is supposed to measure whether management acts on behalf of long-term investors or generate investors, investor long-term value. And we basically ask, do firms that are above the median, that is there a differential effect in terms of CR, in terms of the environmental policies? And what we find is that basically compared to compare above the median, below the median, they emit less at home and slightly less in foreign countries. Now,
Sorry, Zahi, you have 5
yes.
minutes left.
5 minutes is lots of time. Thank you. So what we see here is that basically when there is a strong governance policy, they emit less at home. Obviously, this is open to reverse causality because this measure is based on includes also how you what's your emission policy. It's an ESG measure. But what's interesting is that it is focused on the home emissions. Even if you believe if you think it's a reverse causality, it has a different effect. It's much more impacted by the home as opposed to the foreign emissions. So maybe there is, if you believe in the reverse causality, then it's maybe even a story of window dressing. At home, you emit less, but you actually kind of, you don't care that much about foreign emission. You care, but not as much. The third and last mechanism that we test, but we don't find very interesting results, is basically look at pollution-intensive industries. So these are industries that, based on just these are EU statistics, generate the highest emission per their activity, revenues, or assets. So what you could see here is that so basically what we do, we just look at, it's quite you can see that the first 6 are really, taking most of the pollution compared to other industries. So the idea was, if you're trying to design a policy that somehow targets CO2, you may want to start with the big polluters. I mean, there is little, if you have if you look at the bottom one, repair of motor vehicles or trading motor vehicles, just these are just just selling cars. Maybe there isn't much to do there. These are just parking lots with cars. You may want to put your efforts in the big polluters, for example, refineries or air travel. And what we find is that if we look at firms in the pollution-intensive industries, basically they pollute more, but basically they pollute the same in home, or pollute more in the same degree in home and foreign. So we don't see a lot of much of response or much of variation with respect to the environmental policies with respect to home or foreign. Okay, so let me just wrap up here. So we think that there is bad news in the sense that there is carbon leakage is real. There is evidence about more foreign pollution, more upstream pollution. We like a lot the idea of pushing. No, we don't find any evidence for pulling. And maybe there is a bit of good news that maybe strict policies are associated with a lower global emission. And the overall message is that we need more collective action, because it's almost like you have to somehow having stricter policies at home alone is not going to help. It's just going to push it away. Then I found for you this. It's kind of the message in if you do what's in the bottom left, you're going to get less pollution. Okay. This is what I had for you guys.
Right. Thank you very much, Zahi, for the presentation on Sunday morning.
Yeah.
The discussant is Per Stromberg from Stockholm School of Economics. Per, you have 10 minutes.
Great. Let's see. Okay. You see my screen?
Yes. Can you
do great.
Screen?
Perfect. Okay. And you hear me as well?
Yes.
Okay. So great. So well, thanks to the organizers for letting me discuss this paper. Thanks myself. Okay. So I think this is obviously a very important policy issue. As the problem with climate change is that it doesn't matter where you emit your CO2; it has an identical effect on climate change. So even if we in Sweden have very strict carbon tax and so forth, if the Swedish companies just move their manufacturing to some country where they can pollute without paying tax, we have basically no effect on the climate change. So this is what is referred to as carbon leakage. Okay, so this paper is basically trying to find evidence of carbon leakage. Okay, so Zai went through all the results. I don't think I need to spend so much time on these, but basically the one of the challenges here is obviously has to do with data. They use these CDP data which I assume are basically driven by firms report how much CO2 they emit, and the reason they do it is basically driven by investors. So this is public firms that are sort of disclosing the CO2 emissions. And then I guess investors use them to decide, where they want to invest, to take into account ESG in their policies. So and then they combine this with data on how strict the policy is, which is from the WEF or World Economic Forum survey, and then financial data. And then what they basically find is that, if you increase the strictness of your domestic climate regulation, you see a drop of 29% in your home country emissions, but you see an increase of 43% in your foreign emissions. So this is basically a carbon leakage indication. And you see a slight drop overall in your total emissions. And then there are various other results that Zahi went through. So I guess, one of the questions probably, you have, at least I had just initially, okay, is it good news or bad news? Because on the one hand, you know, you do see a net effect on total emissions of domestic policy. So maybe you could actually declare victory there and say, even if this is a global problem, it actually does matter what you do in your home country, because there isn't at least complete carbon leakage. On the other hand, there seems to be quite a bit of carbon leakage. Okay. Now, to my comments here, one thing that I think we need to think a little bit about is what we mean with carbon leakage and how it's measured in the paper. So I think the at least one sort of very intuitive way to think about carbon leakage is, okay, so I start, you know, there's two countries here. Okay, so I have some dirty establishment, and I have a cleaner establishment at home. You know, here's my my production facilities maybe, and my sales facilities, and then my home country tightens CO2 policy. Okay, so to avoid whatever CO2 tax, I just move my dirty production to a country that has more lax policies, and I really haven't reduced total emissions a lot. Okay, so this is sort of what we're after in the paper, and I guess the results, some of the results are consistent with this behavior. However, there are other things that could happen as well. Okay, so take the following example. So remember that the dependent variable, what we're looking at here, is you know, one of the variables looked at least is percent of emissions that you do abroad. Okay, so take the following situation. Okay, before emissions, you know, a dirty establishment both home and abroad. I'm a multinational. After tightening, I clean up my domestic you know, establishments, you know, where I sort of have to do it because I'm facing carbon tax, for example. I don't do anything to my foreign ones. Okay, so at least in one of the measures they're using, percentage foreign emissions would go up in this case, but I wouldn't probably call this carbon leakage because I've actually have reduced my my domestic emissions. Now you could say, well, but you know, they also look at total emissions, but then you have another issue, I guess, which is take this this issue, same thing as before. Okay, so after this tightening of regulation, I clean up my domestic businesses, and the firm is also at the same time growing. Okay, so here you would actually have kind of a both the percentage and the amount of foreign emissions going up, but I'm really becoming a cleaner company. Okay, so it's going to be very important to sort of control for these things. I think more generally, you know, people or researchers in environmental economics have thought quite a bit about how to sort of think about changes in emissions. Just copied an equation from a paper by Levinson. So, you know, if you think about total pollution for a given firm, okay, you can think about that as, let's say they have establishments in a couple of different countries. Okay, so you could decompose this basically into this last thing here, which, which is, you know, it depends on your total scale and how much how big you are. It depends on how much you're producing relatively in different countries, and it depends on how pollution intensive your business is in these different countries or industries or whatever, right? So you could increase emissions because you grow, because of scale. Conditional on scale, you could change because of different composition across countries, across business lines. And you could, and this I guess is what we're after, if we want to get a cleaner world, you could reduce conditional on composition and scale. You could actually reduce emissions because you use better technology. And in the paper currently, I'm a little sort of confused about which one of these it is, right? So if you find that the foreign emissions increase, is it because you move dirty production abroad, which is, I guess, what we would call leakage? Or maybe you're growing faster in countries that where you happen to have dirtier divisions. Okay, so then I don't know if we call that leakage or not. Maybe you chose to invest more in those countries, in which case maybe we can call it leakage, but maybe it's just because that market grew faster. Or, you could actually be improving your technology more at domestic plants, plus you grow overall, which was the last example I showed in the picture. And that I definitely wouldn't call leakage. Okay, so I think I would push the authors to try a little bit to think about decomposing the effects in this way. Now, one of the challenge, and I'm very sympathetic, by the way, that this is, you have the data you have, and the data is interesting, but it's not perfect, and you can't do a perfect sort of identification, QG type exercise here. However, let me just point out some things that are a little problematic. So these surveys, the emission data comes from these surveys that are basically pushed for by investors, as I understand it. The coverage has increased a lot over time. Okay, so this is really a very highly unbalanced panel. It's very unclear to me how the composition, to what extent these decreases in emissions on average come from different industries being included, different countries being included, versus actually reductions. And then if you look to the right, even if you had a panel, there isn't so much going on, at least if you look at the averages of changes in policy over time. So there's not a ton of power in doing sort of a diff and diff, even if you had a perfect panel here. So I think doing a proper diff and diff here is challenging. And that also means that these regressions can't have firm fixed effects in it. You try to do the best you can to control for firm characteristics and so forth. But we're not talking about within firm changes necessarily in these tests.
Sorry, Per, you have 1 minute left.
1 minute, okay. So then I do think that this is sort of along the same lines. I think we're interested in emission intensities here. Are you sort of investing in using better technology? Is there, so trying to do more on that, I would encourage you to do. I think you mentioned scope 1, 2, and 3 emissions. I think the scope 1 emissions is really the one that's sort of informative in this exercise about what the firm is doing. Scope 2, you have a problem. That's basically the energy you're using. It could simply be that if you have a change in policy in the country, that affects actually the utility firms and what kind of electricity they offer, which will then change the scope 2 emissions of a given firm, but not because they did anything, it's because their suppliers of electricity were forced to do stuff. Scope 3 is interesting in principle, but data is very poor. One thing to also note here is that your results that there is not much reduction in pollution-intensive industries is a little sad, because it turns out that the pollution-intensive industries, 7% of the firms here account for more than 50% of emissions. So that no action in pollution-intensive industries is actually pretty bad news. Final thing here that I do think is somewhat important on these country firm year level regressions, there is a tendency of strict policy firms up here in the right-hand corner to be quite small countries, and a lot of the large countries, this is now emissions, but I think it correlates pretty well with the size of the market and the size of sales in these countries. You see a lot of the big markets tend to be dirtier, and a lot of the small markets tend to be clean. And that's a problem if you think about these, Sweden has a stricter policy. At the same time, if Swedish firms are growing, they kind of have to grow in these dirty countries because that's where they can sell stuff. So I think you potentially could have some spurious relationships there. So anyway, that's my comments. Sorry for going over a bit. I think it's an interesting paper, definitely on a very important issue. So I think I had more patience with methodology since the issue is so important. And there are a lot of data limitations that restrict what you can do, but maybe there's some more things that you can do here. Final word is think about colorblind people who can't distinguish red from brown like me. But anyway, that's what I had.
All right, thank you, Per. Zahi, would you like to respond? And then we have some questions from the panelists. Maybe we can take those from David.
Yes, all right. So thank you very much, Per. I well appreciated and our good comments. I don't have an answer to all of them, but it definitely gave me some ideas of other things we could do. So, for example, you mentioned the growth, maybe uneven growth between domestic and foreign. So one of our variables that we have that we maybe could use is the percent of foreign assets. So maybe we could do something with that.
Do you have sales by country or only assets?
No, only assets.
Okay, that's too bad. Because I guess there's some interesting differences between sales and assets.
No, and I think in many of these are the production facilities. You know, think about cars, right? I mean, so the production is done somewhere else. The assembly is the design is. I mean, each country has its own kind of.
Yeah. So if you had country level sales as well as country level assets, you could actually directly see if it's due to outsourcing of manufacturing facilities versus just different sales in those countries.
Yeah, as far as I know, we don't have this. Probably there is something we could do to check at least whether the unbalanced panel is responsible. Maybe there is something about weighting by country, kind of evaluating, just to check whether there is anything serious going on there. Yeah, but these are, I mean, the composition I think is something that we probably could do more, and to some extent. I think we do have some results because we see the change in the domestic, the change in the foreign, and the change in the percentage. So we could probably do more in terms of interpreting these results. There are some questions in the I see in the chat here.
Yeah.
Do you want me to answer these, or what should I do?
So I think David has a question. So maybe we can go with David's question first, and then maybe we take the other questions privately.
Okay. Hello, everybody. So my question was, I mean, that kind of leakage can happen within multinationals, but I would imagine it also happens, across firms. Like, I'm, having, another firm I'm importing from. So instead of having my own factory that is dirty in my country, I will use, another company to basically buy the, which I'm gonna buy the goods from. That is in a, kind of in a dirty country. That is a dirty company abroad, and that you could check by using sort of the same data at the country level. No, if I'm in a country, so is it the case that I see an increase in pollution in countries that tend to export to countries that have an increase in their regulation of environment or something like that? That would be like a sort of the same regressions as the one you run.
So this is really the scope 3 that we have. So the scope 3 is how much the pollution that went into my inputs.
Yeah, but you could do it using other. What I'm saying is that you don't even need your WEF data. Is what I'm saying. You could do it with trade data.
Right, and so maybe there we should do a better job in relating to the literature, because with trade data, we're not the first ones kind of thinking about this idea of leakage, right? I mean, there is a 20-year. Sorry, maybe I should have again. So there is quite a bit of literature about carbon leakage, but the carbon I should have done. I'm sorry. The existing literature looks at exactly what it looks at FDIs, looks at trade imbalances. Everything is at the aggregate level. There's nothing at the firm level. There's no firm level information.
Okay.
Oftentimes, CO2 CO2 is approximated by the amount of industrial output, for example, as opposed to kind of actually measuring CO2. So the advantage here is really the data. It's CO2 and firm level. hasn't been before. I should have. It's a bad.
But you still have an issue of sort of, okay, are you decreasing CO2 because you're sort of shutting down operations and, you know, we can't grow anymore? And then are maybe other firms picking up that slack and so forth, right? So that's, I think, is also along the lines, depends a little bit on competitive pressure and so forth. If we kill off all the Swedish firms, steel firms, and then the Indian ones pick up the slack, have we really done much for climate and so forth? Which I think this other literature is also.
Yeah. So you know, so maybe there is something more to do in the aggregate. And then we again, if we look at aggregate, the issue of unbalanced panel is really important, because we're aggregating across different firms. Yeah. I mean, I need to figure out how to address this. Thank you so much.
Thank you very much. So in the interest of time, I suggest that we skip the break and go directly to the second paper. And there are some questions in the chat room. So if the authors of the first paper could chat and respond privately, that would be great. All right. So the second presenter is David Desmar from MIT. The title of the paper is Do Investors Care About Corporate Externalities? Experimental Evidence. David, you have 30 minutes. The floor is yours.
Okay. Thank you very much, Dong. So you can see my screen. You can see the mouse also?
Yes.
Okay. Okay, so this is, as you said, a paper. This is an experiment on that tries to test whether investors care about corporate externalities. It's joint work with Jean-François Bonnefond from Toulouse, Augustine, and Paris Sastry from MIT. So the debate this is coming from is the debate that has been discussed already several times in this conference on stakeholder value, where I mean many people have called for firms to maximize something else than shareholder value. So from Elizabeth Warren to Robert Reich to even the CEOs of the business, a round table in between the lines of their declaration. And then for these people, obviously, maximizing shareholder value, if you try to maximize stakeholder value, you cannot really maximize shareholder value simply because kind of the reasoning goes, shareholder value is the sum of future dollar profits of a firm, and it excludes, you know, shareholders' social concerns. Okay, so it excludes kind of private benefits that shareholders would derive from the company doing good. Yet, if shareholders are altruistic, actually their pro-social preferences may affect prices. So it should be reflected somehow in the price that shareholders actually do care about something else than just dollars, simply because stock prices are not profits. Stock prices can be a vote of confidence for the firm. It can be a way to owning a firm that does good can be more than just, you know, the claim on dividends, while owning a firm that pollutes can be less than the claim on dividends. So that's the way preference for corporate social responsibility has been modeled in various papers. I'm not even sure I have all of them here, but since, you know, the early 2000s. Until recent papers by Pedersen, Pastor, and Stambo, that, you know, when you own a stock, typically what you own is not just a claim to future dividends, but also, you know, private benefit that comes from, you know, how the firm is behaving and how you judge the company is behaving. There's also the intuitions behind social stock exchanges, where social enterprises, the stock of social enterprises, which are like essentially companies that are not trying to make money, I mean, they're making a little bit of money, but that is not their primary goal, can be traded. Okay, and there's also indirect evidence that shareholders actually do care about not just, you know, dividends, dollar dividends, but also how firms behave, from even studies and even recent paper by Hartmann and Zussman. Which is on mutual fund holdings, which is an investor holding of mutual fund shares. So there is indirect evidence, but nothing really direct. But, you know, that's kind of something that's everywhere in models and everywhere. So basically in this paper, what we're trying to investigate is why and how investors' social concerns are priced. Okay, so we're gonna start from an experimental paradigm where it is priced, as you will see, and basically we're gonna ask what are the channels through which investor social concerns are priced. Okay, so let me, before I explain a little bit more what we do, let me just, unroll a few hypotheses of how investors' preferences are channeled into prices. Okay, what drives the pricing of social preferences? So one possibility is simply something that's being discussed in the literature, in particular by this paper by Stu Gilson and others, but in other papers too, which is impact investing or value alignment. So impact investing is very much along the line of the paper that Augustin has presented yesterday, where basically by owning a firm, by conditioning your investment in a firm onto this firm's good behavior, that's what you want to achieve basically by investing in some firm. So firm is polluting, and you're gonna tell the firm, okay, if you pollute less, I'm gonna give you money, or I'm giving you money under the condition that you end up polluting less. So that's kind of impact investing. So you buy the stock of the firm to change it. Or value alignment, where basically you don't really care about your own impact. You don't think you can have an impact on the firm, but you want to reward some of the firms for their good behavior in a sense. And that kind of goes back to different kind of preferences, moral preferences. Like is your moral preference unconditional on what you can do, or does it depend on on your actions? Another discussion that is often made is simply, going back to the Friedman 1974 New York Times op-ed, is the idea simply that pro-social investors may price pro-social preferences because these are not the pro-social preferences these are not really the preferences of the end investors, but really of the mutual fund managers that are investing other people's money. So it's about doing good with other people's money. So it's just, the price of high ESG rating firms is simply high because asset managers want to feel good about themselves. Another channel that we can also discuss is the Hart and Zingales argument about the limitation to Friedman's argument, which is that Friedman says essentially, if I own a stock of a company that donates money to schools in Africa, I don't really care about that because I can donate money to schools in Africa myself. So the company has no particular comparative advantage at achieving that purpose of donating money to schools in Africa. But there are situations in which companies have a comparative advantage. For instance, it might be very hard to capture CO2 and to put it back from the air into the ground, but not polluting in the first place is kind of an easier way to fix that. And so maybe as I would want to own the stock of companies that do well, or invest in those companies in order to because companies have a comparative advantage at implementing the first best that I want. And then also your channel that matters is also the clarity of firms' pro-social behavior. And in a sense, that relates to the debate on greenwashing, CO2 offset programs. So greenwashing is really like, we don't really know whether the company is actually doing good or not. And the offset program is more like, the company at the same time emits CO2, but at the same time it buys carbon credit in order to, basically have a negative impact on CO2 emissions, and it's kind of its own moral attitude is unclear. And so, does it affect, investors' pricing of pro-social preferences? Okay, so basically testing this hypothesis is hard in the field. Simply because prices typically conflate profit reducing CSR and profit increasing CSR. So that's a well-known problem that, when a CSR decision is announced, it's not clear whether it's going to increase profits, in which case prices could go up, or it's going to decrease profits, but increase kind of the attitude of the firm, and therefore, generate, a positive reaction also because simply people like it. And it's also hard to isolate those different channels. So that's basically for these two reasons That's why we're running an experiment on 1,500 participants. So it's a fairly large scale experiment that allows us to investigate these hypotheses. So before I go into the details, that's the experiment design in a nutshell. I'm gonna get more into the details, but that's the experiment in a nutshell. Basically, participants are presented with stocks, and those stocks pay a cash dividend pi minus C, and they give C to a charity. Okay, so as a participant, I can buy this stock. Okay, so pi minus C is a value, C is another value. Okay, so pi is basically the profit of the stock, and some C is given to a charity. And participants are asked to bid for these fictitious stocks. So then what we investigate, the empirical object we investigate is this beta right here, where across participants, what we do is that we compute this thing here, which is called which we call the excess bid. So that's the bid of the participant above and beyond the cash dividend of the stock. So it's kind of, you know, the extra value that the participant attaches to the stock. That's due to the fact that the stock is paying some value C to a charity. And you know, basically what we ask is whether this excess bid is sensitive to how much the company is giving out. So if beta is 0, then people are Friedmanian, they just value stocks as equal to the cash dividend. If beta is more than 0, then people value somewhat the donation. And if beta is 1, they really value $1 of donation as $1 of value. Okay, so that's kind of how the donation is translated into value. So we call beta the pass-through or the altruistic pass-through. And basically, we explore how beta changes across various conditions. So going back to the channels I've discussed earlier, we're going to discuss impact investing versus, you know, versus value alignment by asking whether, you know, a successful purchase changes the firm behavior or not in our experiment. We're going to ask whether participants can donate directly themselves, in which case, you know, the comparative advantage of the firm to donate is basically less because now participants can donate themselves. We're going to ask whether participants invest their own money or they invest another participant's money. That's to test the moral hazard kind of thing. And then, you know, we're going to vary also the clarity of the firm's pro-social behavior by, you know, introducing uncertainty. That's the one thing. And the second thing is basically by having the company donating to a charity and taking money from a charity at the same time. This is all actual money, so I will show you how it works, but that's kind of the idea. So basically, we're going to see whether, you know, these conditions affect the altruistic pass-through. And so basically what we find is very simple. It consists so first, in the paradigm, whether firms give away to a charity or not, has actually a fairly high pass-through. So that's indeed people price, you know, good behavior. Bidding is overall consistent with deontological preferences in the sense that it's independent of impact. It's independent of whether I'm managing my own money or not. It's independent on whether the company, whether I'm allowed to donate my own money or not. It looks like a vote of confidence in a sense. It's kind of the company does good, price is going to be high. Company does badly, price is going to be low. That's what seems to be happening. And of course, clarity matters, but in a simple additive way, in the sense that, you know, people value an expected charity donation exactly the way they value a certain donation. Basically, it's the same pass-through. It's 0.8. And if a company, you know, gives $1 to a charity, takes $0.5 from another charity, then, you know, people value this as 0.8 times 0.5, which is 1 minus 1, 0.5. Okay, so that's consistent very much with, you know, with the models that I've discussed in the previous slide, you know, the models that have been written. And also, you know, you can easily build some kind of portfolio theory with private benefits in a sense as part of the portfolio returns. So I'm gonna, in what I have left, I'm gonna describe the experiment and go over a few results, perhaps not all of them, but you feel the spirit of what I have. So let me describe the experiment first, okay? So we recruit 1,500 people on MTurk on 5 consecutive batches. Some of them in 2019, some of them are in the summer of 2020. After the pandemic. But it's reasonably. I mean, their answers turn out to be reasonably reliable, as I can discuss later if you're interested. And participants, each participant is asked to value 3 stocks. So that's going to be 4,500 rounds, a bit less, as you will see in a second. So we're going to about 4,000, rounds of stock valuation. So that's reasonably sized data, where basically they're presented in a random order with 3 stocks: a neutral stock that does not donate anything to any charity, so it's just a pure profit; an ethical stock which donates some of the pie profit to a charity; and an unethical stock, which is essentially, taking away money from a charity. I will explain to you in a second how that works, but essentially, it's kind of to simulate also the polluting stocks, as well as good doing stocks. And valuation is measured through a standard bidding mechanism in the experimental literature, whereby basically it's a second price auction with a machine. So the participant bids B, the machine draws a random, price, and if the participant wins the auction against the machine, so if the participant bids more than the random machine, the participant pays the price, the random price, to own the stock. And then, upon owning the stock, the participant gets pie, and C may or may not be given to a charity. And it's well known. It's a well-known algorithm. It turns out to give good results, as you will see, etc. So that's kind of, it's totally standard. So now let me just describe a bit more in detail, but that's kind of the idea. So you define. We initially. So how does it work? Like sequentially. So first we defined 2 wallets with initial endowment. So the participant is given $2. It's $2. It's actual money. So the participant is given $2 of money, and the charity is given $1. Why do we have a charity wallet? It's to implement the pollution thing. So basically, whenever the company is going to be an unethical company, money is going to be taken from the charity wallet. So that's money that we as experimenter pledge to give to the charity, but that money is going to decrease if upon the appearance of the unethical company. And participants, so it depends on the conditions. It turns out to not matter, but there are 6 charities that kind of span the space of causes, from children to food to development, etc. That in some conditions the participant can pick. In some other conditions, it's just randomly chosen. It turns out to not matter actually, not that much. We then provide, before they actually start doing the thing, we provide them with a simple example of BDM bidding. So Jean-François, who's the psychologist of the group, was very afraid that people would not get it. And so basically we describe how that works, in an example with a step-by-step explanation of the effect on both wallets. And then something that we believe is very important and we are very happy with, a very good, I don't know that it's an innovation, but at least it's something that that gives us a lot of confidence in our results, is that we have a practice quiz. So the practice quiz makes sure that all consequences are understood. So before we actually went to the practice quiz, we actually ran a first live test in the lab. So Jean-François sat with physical participants and could see that, whether they were struggling and where they were struggling. Then we ran a pilot survey to make sure that, people understood the thing. So it was not really an experiment. It was just checking that people understand what happens, sequentially. And then basically we set up that practice quiz that we embed in the experiment, where there are like 2 examples where people are presented with one ethical and one unethical firm. And then, they have a successful bid, a failed bid, and we ask them to forecast what will be the impact of these bids on both wallets. And they cannot proceed unless they ace the quiz, and they have 3 attempts max. Okay, so we're sure that the people that, you know, the data that we have is from people that understand the consequences of their choices. They really do understand. Yeah, that's it. Okay, so they really do understand. So then we have 4. So then we proceed to the actual experiment. If you pass the quiz. So there are 3 bids, as I said, because there are like 3 companies that are presented in random order. It turns out that the order doesn't matter that much, but it's just to control for priming, for the sequence, you know, that might matter. And profits are drawn randomly. Charity donations are drawn randomly, you know, from $0.5 to $1 for profits, from $0.1 to $0.5 for charity donations. It's drawn at random. And then we recap the final amounts on both wallets. Okay, so that's the idea. So then, of course, we have the various conditions that we need in order to test our various channels. So besides the baseline, we've got the one with impact. So the one with impact is very simple. It's basically about saying, okay, the charity wallet will be affected if and only if the bid goes through. Okay, so if I manage to buy the company, then the charity is going to get money. If I don't manage to buy the company, then the charity is not going to get money. Okay, so that's kind of the impact condition. And the baseline condition doesn't have that. In the baseline condition, whether I buy the company or not upon my bid, it doesn't change, you know, it doesn't change anything as to whether the company receives something or not. So it's kind of what we call the impact versus, you know, value alignment kind of condition, basically. And where one condition, you know, whether I buy the firm or not doesn't matter. On the other, it actually affects, you know, whether the company, the charity receives money or not, or is taken money from or not. So that's the impact one. Then we just allow people to donate directly at the end, and we warn them in advance of that possibility in kind of the comparative advantage condition, where basically so in the baseline condition, they're not allowed to donate. So maybe that's why, you know, they kind of, you know, they may tend to overbid for firms simply because, you know, that's kind of the only way to donate in a sense. So we allow people to donate directly at the end. There's the moral hazard condition where basically we implement some kind of delegation game where they're told that people that they're not managing their own money, but the money of another participants in the list, and they are actually, because it turns out that the wallet that they have at the end of the game is given to, you know, the next participant on the list. So it's really they're really managing someone else's money. We make sure in the quiz that they understand that it's not their own money, but the money of someone else, you know. So they really understand. So in the quiz, we're sure that they understand. Otherwise, they don't pass the quiz, they don't participate. And then we implement, you know, the random donation, you know. So there's a toss of a coin, and, you know, the charity may receive $0 or $0.50. And same for the ambiguity condition, where basically at the same time the company implements a positive and the negative donation. You know, so that's kind of, you know. So we have those different things, and we end up with 4,100 rounds of bidding. What are the results? So I have how many? How many minutes do I have? I can't hear you. Okay, I can't hear you. That's
sorry,
okay.
9 minutes. Sorry. Yeah.
9 minutes?
Yeah.
That's great.
8:30.
Okay. So first, what the so the first the paradigm in general, like kind of the experimental paradigm in general, kind of achieves sort of the baseline fact that we care about, which is that, you know, donation, like non-direct dollars, are actually priced in those bids. So essentially, so that's kind of the key thing. So we run that regression, which is on the cross section of our results, of our experimental results. On the left-hand side here, you have what we call the excess bid, which is the bid minus the selfish dividend, or the dollar dividend that the company, that the stock is paying. Okay, so the spread, so sort of, you know, the excess bid in addition, in excess to the dividend, on how much the stock is donating. Okay, and basically the sensitivity here is the pass-through, and that's the result here. The graph here that you're seeing is just the result of that regression. Okay, so it's the average excess bid per charity donation. Remember, charity donation is discrete. Okay, it goes from minus 0.5 to plus 0.5. So it's fairly linear, and you know the constant is almost 0. I think it's fine to consider that it's 0, and beta is 0.8. So essentially, each dollar of charity donation gives rise to an increase in the price by 80 cents. So that's kind of, you know, it's a fairly high pass-through, which is good for us because we want to make it vary. So it's good that we start with a high pass-through. And interestingly, it's symmetrical, completely symmetrical. So if a company donates $0.50 to a charity, the price is going to be 0.8 times 0.5 higher. Okay, so 0.4 higher. If a company takes away $0.50 from a charity, then the price is going to be 0.4 lower. Okay, so it's kind of, it's the same, it's symmetrical really. Okay, so now let's try to investigate the channel by basically changing, you know, the conditions. So the first one is impact. So basically, remember there are two. So here in this graph, in this table, there are two columns. Column 1 is the baseline. Okay, so it's the base. It's not all of the data that I showed you before. So it's just, you know, it's just the corresponding baseline here. So you have indeed that every dollar of charity value generates an excess bid that is $0.8 higher. Okay, so that's column 1. And then in column 2, what you have is the corresponding conditions. So where, like, you know, where people were subject to the same, you know, with the same people in the same experiment, the same batch, where people are now told, and we check that they understand, that the charity only receives money whenever the bid succeeds. Okay, if the bid fails, charity doesn't get money, or if the bid fails, charity is not taken money from when the C is negative. And here we see exactly the same path through. Okay, the test, the p-value of the different tests is very large. So essentially, what we're seeing here is that it doesn't matter at all whether the charity is actually going to get the donation or not. If my bid is successful or not, what I really want to basically reward firms for good behavior in a sense, and that goes in favor of kind of the value alignment view of ESG investing over the impact investing view in this particular setting, at least. Remember, we quiz participants to make sure that they understand the difference. That is kind of, you know, that they're pivotal in the second experiment. Okay, then we test comparative advantage. So here we're comparing two conditions. One condition, it's actually slightly different from that, but you know, that's fine for presentation. So here there are two different conditions. So condition 1 is where is the baseline, and condition 2, so the second column, is a situation where people can actually donate themselves. Okay, so they can donate money. So whenever they can donate money, actually, so if we believe that, you know, whenever the comparative advantage of companies to actually do good disappears, the excess price of good doing companies should go down. We don't find that at all in the data. Okay, so here the sensitivity is the same. Whether the company has a comparative advantage at donating versus not. So that's again, you know, kind of, again, going in the direction of saying it's a vote of confidence for the company rather than just, you know, a way to donate. You know, it's really just it's a vote. It's the company is doing the right thing in a sense.
David,
so
sorry, you have 3 minutes.
That's good. Moral hazard. I have 3 tables to show, so that's perfect. So moral hazard now. So moral hazard does not drive pricing. So here I'm comparing the two conditions. So the conditions where people manage other people's money, and the condition where people manage their own money. So again, here I'm showing the two beta parameters here, the two pass-throughs. So it's true that the pass-through under delegation is slightly higher, but not significantly so. Okay, so the p again, the p-value is fairly high here. So I still tend to overprice, good doing stocks a lot, even when I'm managing my own money compared to when I'm managing other people's money, in a sense. And I don't even see a difference here. There's a slight, positive difference, but it's not significant again. So managing other people's money does not seem to make participants bid significantly higher. And now the last two conditions, which pertain to clarity of ESG behavior, of CSR, of socially responsible behavior. So the first one is basically by comparing certain. So column 1 is a certain donation. So donation is certain. It's going to be $0.5 given to charity X. Column 2 is uncertain. So can we there's under one. So I'm gonna toss a coin. We have a coin that flips, and we have a picture with a coin that flips, and then we tell them, okay, you can have the positive or a negative charity value, and we don't know which one it's gonna be. And so basically, the regression we run here is the excess bid on the expected charity donation here. Okay, and what we find is that the pricing of the expected donation is the same as the pricing of the certain donation in the baseline condition. So in a sense, uncertainty affects pricing, but really in a way of taking the expected value of charity of charity donation, really. Same for ambiguity. So now ambiguity is the one where the company at the same time donates and takes away. Okay, and here we have this number, which is the net donation. Okay, on which we regress the excess bid. And again, what we find is that the coefficient on the excess bid tends to be the same. There's a slight difference here, so I mean statistically, but it's barely significant. So I guess the takeaway is that there's not much difference. If the net donation has the same effect as a certain single donation to a firm per dollar of net donation, in a sense. So again, ambiguity affects pricing, but in a very additive way. So the bottom line is this. In our experiments, corporate donation is 80% priced. Okay, that's not due to confusion. We check with a quiz. Such pricing is consistent with deontological preferences. Okay, independent of impact, of moral hazard, of a comparative advantage. So not on impact, but really, it really seems to be a vote of confidence for the firm. Of course, uncertain or ambiguous CSR is going to be priced in. Of course, if it's not less than probability 1 that the company is going to do good, the price is going to be lower, but in a way that is completely additive. So the consequences are twofold. First, shareholder, but I won't be insisting on that because authors don't really agree on this. But the second point is really the one that I want you to take away, is that it's possible. So people behave kind of deontologically. And second, it seems possible to extend standard portfolio theory, which is with cash dividends, to non-pecuniary benefits for stocks. Basically, you can add the non-pecuniary benefits and assemble stocks together in a coherent portfolio, and that will give you the equivalent of a single firm. And that's it. Thank you.
All right. Thank you very much, David. The discussant is Enrichetta Ravina from Northwestern. You also have 10 minutes.
Okay. Yeah. Can you see my screen? Yes. Okay, so thank you very much for inviting me to discuss this paper. I found it very interesting and actually very topical as well. So I'm going to summarize very quickly the paper. David did an excellent job in presenting it, so we don't really need it. So the question of the paper is, do shareholders value ethical behavior in firms? And if they do, how much are they willing to pay for it? And what is exactly the mechanism that induces them to pay that much? They run a lab experiment to answer this question using 1,500 subjects on mechanical Turk. And the advantage of a lab experiment is that it allows them to abstract from a lot of things that are going on in real life and focus on this mechanism. The paper and the presentation are slightly different, but I don't think it will matter. So there are 5 treatments. 2 treatments are such that you cannot donate in the end. So if you want to reward the company that is ethical, the only way you can do it is by paying a higher price for it. And you can do it either in a baseline setting in which the company will receive some donation, regardless of whether you end up buying the stock or not, or you can do it in a setting in which you are quote unquote pivotal, meaning like maybe pivotal is not the right term. It's a setting in which the charity is given to the company only if you actually buy the stock. So there are a lot of people, and maybe you are atomistic, but you do your small part in giving money to this company. And then there is a donation setting in which, in addition to paying more or less for an ethical company, at the end of the experiment, out of your profits, you can also take part of it and give it to the company. So what they find is that subjects are willing to pay about 80 cents for every dollar that is donated to charity. And this effect is linear, meaning, it doesn't matter if you double the amount, you double the willingness to pay. And it's also symmetric. It's the same type of relationship when we talk about unethical firms that take away from charity. One other thing that it's interesting is that being pivotal or investing on behalf of others doesn't change the valuation. And finally, the possibility of donating to the charity at the end doesn't seem to affect the behavior and the pricing as well. And this, I thought, is a little bit in line with the Milton Friedman idea of, we would really like firms to maximize their profits because as shareholders, we could always take part of those profits and give it to a firm. And here, the subjects don't seem to think that way. And maybe it's the setting, or maybe this is an idea that is not intuitive in real life unless you explain it to people. But it doesn't seem like that people say, oh, I just go for the maximum profits and then I can distribute money myself later. Okay, so these are my comments. First of all, I like the paper very much. It's great that we have the possibility of doing lab experiments because they help us understand the mechanism that too many confounding effects in real life. Of course, I'm the discussant, and so I will have to also say something more critical, hopefully constructive about the paper. So one question that I have, one issue that I have is the sample selection. So the workers on Mechanical Turks tend to be lower income, maybe younger than the typical investor. And even controlling on age and income, it's possible that they are, let's say, unobservably different. They might have different preferences. There are a lot of papers that say that studying economics makes people less charitable, more greedy, more likely to want to free ride. Even just priming them for their profession, like in the finance sector, makes them less compassionate. So one question that it would be interesting to address, and maybe the authors know, I think they know who invests in the stock market and who doesn't. Maybe they know the occupation. It would be interesting to see if you are primed or if you are in finance or economics. Are you more profit-oriented and are you less, quote unquote, deontological in the way you address these companies? Another thing is the stake. So maybe in lower stake settings, people feel like they want to reward charitable companies, but when it comes, for example, to their 401k or managing large endowments or mutual funds, then they think about profits more. So this is one critique that is always true in experiments, and maybe if you have time and if you have the resources, you could see if increasing the stakes generates a different type of behavior, or there is still the same effect. Finally, for this page at least, I have a question also about the way the quiz is set up. So the authors should be commended because they make really every effort possible to make sure that their subjects understand what they are doing. They check and they exclude those that don't. And one thing that I wonder is whether the way the quiz is set up might create an anchor or a misunderstanding in the experiment. So if you look at the quiz, the ethical company has a profit of 1.5 and gives to charity 0.4. So that at the end of the day, you as an investor end up with 1.1. The unethical company gives is a much lower profit, 0.7, takes away from the charity 0.4, so you end up with 1.1. And I wonder if this, and maybe my reading of the paper, but I wonder if this leaves people with the impression that charitable companies are also companies that have higher profits, that all else equal, you end up more or less with the same amount, 1.1. So you might as well give to charity then. And this is a possibility. Finally, statistical power. The authors don't find that a lot of the treatments are significant, delegating, for example, having an impact, direct impact on how much money the charity receives. And I wonder if that is due. Economically, the two coefficients are slightly different. Maybe even if you look out of $1, they are maybe significantly different, but they are not statistically different. And I wonder if there is a way to add more subjects to each of the arms and see if we can separate those. Maybe we cannot. Possible extension. So I think one thing that it would be interesting to see is since the demographics for these people are available, is to understand how the distribution of the preferences relates to the demographics. Is it true that millennials, for example, are more likely to give to this type of company? Like, it's at least the word on the street that that's the case. Democrats, women, are there any differences, and are these preferences measured in the lab line up or tell us something different than what we think goes on in reality? Then what happens when we put these people in context? And so I think an interesting extension would be to see, what if I have to pick what if I have to decide whether I want to give money to a tobacco company that also does a lot of charity? They do greenwashing. How do they react? Is the $1 of charity worth the same, or is it less? Do they really care about giving to charity, or are they rewarding the company and their business per se? And what happens when it's more difficult to understand how much of the money that you give, quote unquote, to the company by purchasing the stock actually goes to CSR. And here I think the authors, with the clarity of treatment, are already going in that direction. Finally, I think it would be interesting to see what happens when other people can observe your actions. So, or whether you can sort of signal you being good for to others. Would you be willing to pay more or less? Would it matter across the different settings? And one thing that I thought it was interesting is also that it doesn't seem to matter what type of charity you are donating to. So, which is maybe it's real, maybe it's just the donation itself, but it seems counterintuitive. Maybe some people care about the environment, but really don't care about children or something else. And so it seems that they should sort of be more likely to give to certain causes than other. And maybe the correlation between these preferences, the demographics, will tell us something as well. Like the charity that you got, depending on your demographics, were you more or less willing to give?
Cheta, you have 1 minute.
Okay, perfect. So this is basically the last slide. One question I think that is results, at least may come to my mind, is that so now that we know and we have this measurement and these results, either qualitative or quantitative, what can a company do then to maximize share price? What should you tell people? What should you do? Is it worth it to give to charity? One other thing related to this, it seems that the preference for corporate social responsibility are very strong in the lab. Maybe, well, it's difficult, like the author points out, to really pinpoint this mechanism in real markets, but they seem quite strong. And I wonder why. What are the features that in real life dampen this effect? Maybe we don't trust that the companies are giving to charity. Maybe we don't realize, or it's not the most salient thing that they do. What else is going on? Other comments we can talk about later. So to conclude, this is a very important and interesting question. How do investors value CSR? And the authors designed a very clever experiment and found interesting results. It's definitely a paper worth reading, and I look forward to read the next version. Thanks a lot.
All right, thank you very much. David, would you like to respond to the discussion?
Yeah, but just more like because it was a very thought-provoking discussion, so it's very it's not really response but reactions to the reactions. Thank you very much, Enriqueta. It's great. Please send us the slides. Just a few things. So on demographics, I agree. We should look at them again. My recollection is that we don't find that much. I think an interesting fact, and I don't know what it means, but I will just deliver it this way, just like this. We ran the experiment on 120 MFin students, so Masters in Finance students at MIT, from like various countries, mostly foreigners. I mean, not US citizens. And it turns out there is not that much difference. So they were not even playing their own money. So it was like fictitious money. And they gave very similar results, like a slightly lower pass-through, but I don't think it was significant. So in a sense, that's kind of a demographically very different sample, but it's not professional. I agree with you that why not having like higher stakes and professionals, why not? Something to think about. On having more detailed context, like having a tobacco company that at the same time is funding lung cancer research, for instance, that would be like the extreme thing. So how would you? So we could try that. The thing is, there is virtue in having a very stark, very simple context, and that may explain why actually we're getting like those very high pass-throughs in a sense. So maybe like if we start like feeding people with more information and having them like figure. So yeah, it's a good question. I mean, we have the feeling that we get more external validity by having a starker context, but at the same time, you know, I don't know, because if in the tobacco company example, depending on whether you're a smoker or not, like you're bringing in your entire like internal universe to the lab, and we want to try to avoid that. But I agree with you that it's not an obvious decision to make. The last thing is on the irrelevance of the charity. So whether like it's, you know, food for the poor or save the children, etc., it doesn't really matter whether you choose it or not. And you know, so it's kind of so in a sense, it means people don't have real preferences. It goes in the direction of the rest of the additivity results. Like, you know, like when you have like an uncertain, you know, donation, a 1 or 0, people put 0.5. When it's ambiguous, like +1 and -1, people put 0 or something like this. And again, here you kind of add everything up. So it's kind of, it goes in the direction of saying we could build a portfolio theory of pro-social behavior, something like that. Yes, but yeah. Thank you very much, Enriqueta. Please send us the slide.
All right, thank you very much. So we are 4 minutes behind the schedule, but I think we're going to need a break. So let's take a 5 minutes break and we come back at 3:45. Thank you.
Thank you.
All right, welcome back. Let's continue our very fruitful discussion. So in this session, we're going to have 2 papers, and then John will discuss both papers. So let's first welcome Adrian Lam from Imperial College to talk about the economic costs of climate change. You have 30 minutes.
All right, thank you, Dawn. I would like to thank the organizers for accepting this paper, as well as for you guys to attend this session. So I'm super excited to talk about our paper, The Economic Costs of Climate Change. So this is a joint work with Claudia Custodio at Imperial, Miguel Ferreira at Nova, and Emilia Garcia Ependini at Zurich. So let me start with the motivation. So it is generally agreed that global average temperature will likely increase by at least 2 degrees Celsius relative to pre-industrial levels by mid to late 21st century. And the number of occurrences of extreme weather events are also likely to increase. So associated with this is that there can be a lot of potentially devastating social and economic outcomes. Now, the effect of changes in climate on economic outcomes are not just long-term. So there are a number of studies that find higher local temperatures affect short to medium-term economic outcomes, such as agricultural activity, farmland value, worker injuries, and total factor productivity. So I think that the last 2 points are very interesting in the sense that if we find local temperature affecting establishment level productivity, then without any friction, it should just aggregate up and it should affect firm sales. But it seems like this isn't the case. So the evidence on temperature affecting aggregate firm sales is actually mixed. So in this paper, the research question that we have in mind is, how do changes in temperature affect firm sales? Now, we think it is not super easy to do this empirically, because first, sales is determined by supply and demand. It is unlike agricultural outcomes such as crop yield. Then temperature may also affect both the supply and demand for a firm's product. So what we are going to do in this paper is that we use production networks as a laboratory. So essentially, we are looking at the supply chain, we are looking at inter-firm sales, and we use an identification strategy comprising of 3 elements. So first, we argue that changes in temperature are exogenous to individual firms' activities, at least over the short horizon. Then, well, because suppliers are located in different locations, they are differentially exposed to changes in temperature. So what we are going to do is that we will compare changes in sales of suppliers to the same client in the same year as an attempt to control for client year-specific demand shocks. So let me walk you through this in a graphical manner just to highlight the intuition of our estimator. So let's just focus on one client, client J. So in 1 year, client J has a total demand for intermediate goods. And conditional on this demand for intermediate goods, client J buys from 3 suppliers located in different locations. Now suppose that supplier 3 experiences a hot year, and we also find that the sales from supplier 3 to client J decreases. Now suppose we find this relationship appearing systematically across many client-supplier pairs, then we can possibly argue that it's really the changes in local temperature affecting the changes in inter-firm sales conditioning on the demand by a client in a year. Now, so put this intuition into an empirical specification, what we have is the following regression model. So the dependent variable is the change in log pair level sales. So what we are looking at is really the sales from supplier I to client J in year T. The key independent variable is this change in temperature. So we're looking at the time series change of the temperature in a location of the supplier. Then for some specifications, we also control for average precipitation because weather variables can be correlated. And we have some firm financial controls that are lagged. And what is most important is this delta JT, which is a client year fixed effect. So the idea is we're trying to absorb the client time level demand shocks, and we try to compare the differential changes of temperature on the pair level sales. Now, the inclusion of this client time fixed effect requires us to look at client-supplier pairs where a single client purchases from multiple suppliers. So it's really a differential estimator that we are looking at here. So let's have a very high-level overview of the results. We find that a 1 degree Celsius increase in average daily temperature leads to a 1.2% to 1.9% reduction in interfirm sales. We explored the heterogeneity, trying to understand the economic mechanisms behind, and we find that there are 3 mechanisms. First, we find that labor supply and productivity seems to be a channel because it's consistent with prior literature. Then we also find that financial constraints and adaptability plays a role. So if firms doesn't have the capacity to adapt or to mitigate this weather shocks, then this will show up in their sales. Then we also find switching costs to play a role in understanding our findings. Then we also find that extreme heat and extreme cold events have a larger negative impact, ranging from 6 to 8% for extreme heat and somewhere in the magnitude of 30% for extreme cold events. So these are massive. So the way we think of how this paper relates to the literature is that there are a number of papers finding heat or temperature reducing productivity and or firm performance. So basically, the paper by Grafstein and Kahn, as well as Chen et al., find that local temperature affects establishment level productivity. Colmer, Martin et al., they find that temperature affects value added and lock employment, but not really a lot on productivity. Then there's also this paper by Nora, and I'll just not spoil her results here because she's presenting it next. Now, so what is super interesting to us is that there's this RFS paper by Adam et al. That find temperature has no effect on sales, productivity, or profitability. So we kind of see mixed evidence here. So in this paper, what we are going to do is that we provide an estimate of the impact of local temperature on firm supply, controlling for demand shocks. And we think this is very important in highlighting how temperature will affect firm cash flows, because by really understanding this, we can really think about policy and think about what kind of incentive shapes firms' decision in incorporating measures to mitigate exposure to climate change risks. Now then, let's go into the data. So we use CompuStat segments for the supply chain data. So it's a data set comprising of client-supplier pairs in the United States in between year 2000 and 2015. So these are main clients. Suppliers have to disclose these kind of main clients, which is defined as if these clients contribute to more than 10% of sales of the suppliers, then they have to disclose these clients. Now we have this name matching algorithm that we hand match the pairs. And we find that these are essentially main clients because the purchases from them represent more than 30% of suppliers' total sales. Now for the weather data, we use Prism Climate Group for daily weather variables, which are super fine, super granular. So this is a gridded weather product data at the 4x4 kilometer grid in continental United States. So essentially what the climate scientists here do is that they interpolate these weather variables from nearby weather stations with state-of-the-art climate engineering controls. So these are smooth and scientifically valid estimates. Then we obtain extreme weather events data from the NOAA storm events database. We aggregate these weather variables to the headquarter county level and adjusting for fiscal year month effects. So in the end, we have this sample. The unit of analysis is at the supplier client year level. We have more than 12,000 observations, of which there are more than 1,800 unique suppliers, 400 unique clients, on average 700 observations per year, and 5 suppliers per client per year on average. And this is key because our identification strategy really requires on a client buying from multiple suppliers. So some key summary statistics. So we are looking at the change in log sales at the pair level. So the mean is positive with quite a bit of dispersion here. So since we are aggregating weather variables in a year, the average temperature, the level of it, is around 13.7 degrees Celsius. Again, there is also quite a bit of dispersion, and this is an annual average. So we're averaging in a year, so that's why we have this figure here. The key independent variable is the change in temperature. So as expected, it's very close to mean, close to zero in the mean. But what is remarkable is that this change in local temperature has a large dispersion. The standard deviation is almost 0.9 degrees Celsius. Then we also have some extreme cold events and extreme heat events, and these are really extreme events. They are very rare in the sample, but then we have also included them just to try to see if we can see some consistent results to our hypothesis. So here are the baseline results. So in columns 1 to 3, we do not control for precipitation, and in columns 4 to 6, we control for precipitation. So across columns, we have different fixed effects trying to absorb the type of unobserved heterogeneity at the corresponding level. And because weather variables are spatially correlated, so we are clustering at the county level. So what we find is that the coefficient of the change in temperature variable is statistically significant, and economically it's also quite meaningful, because what it implies is that a 1 degree Celsius increase in local temperature leads to a 1.2% to 1.9% reduction in interfirm sales. Now remember, the dispersion of this change in temperature is around 0.9 degrees, so we think that this is actually something that is happening quite frequently. So I think the baseline results suggest that after controlling for total demand of intermediate goods by a client in a year, we find that local temperature shocks will lead to a reduction in interfirm sales by the suppliers. Next, we want to understand the economic mechanisms behind, and we have 3 major channels in mind. First, we have this labor supply and productivity channel. So the idea behind this is really consistent with the prior literature, which shows that local temperature affects establishment level total factor productivity and worker productivity, and it reduces labor supply. The hypothesis we have in mind is that we expect the negative effect of temperature to be more pronounced for labor-intensive or heat-sensitive firms. So we do this by doing a set of heterogeneity analysis using some proxies for labor supply and productivity. In the first 2 columns, we split the sample by whether the firm is in manufacturing industries or not. So the idea is that manufacturing industries are more labor-intensive, they rely on more worker productivity. And in that case, we should expect firms in manufacturing industries to be driving our results, which is the case, and the managers is slightly higher than our baseline estimate. Whereas if we look at non-manufacturing industries, there really isn't much going on there. Then in a similar spirit, we split the sample by whether these firms are in heat-sensitive industries or not in heat-sensitive industries. So heat-sensitive industries are really industries where the major economic activities are taking place outdoor. So the workers are there, they have to subject to these changes in temperature because they're working outdoor, and in that sense, they are more heat sensitive. So we do expect heat sensitive firms to be more affected by local weather shocks, and this is also what we find. The magnitude is also quite consistent with the manufacturing industry's results, and we also don't find much going on for non-heat sensitive firms. Then the third analysis is to split by this labor intensity variable defined as number of employees divided by total assets. So the idea is that if the employee to asset ratio is higher, then you really is a more labor intense firm. And in this regard, we do expect firms with higher labor intensity or higher employee to asset ratio to be driving the results. So here we split the sample by the mean value. And again, consistent with our conjecture, is the high labor intensity firms driving our results, whereas there's not really much going on for low labor intensity firms. So together, we think these set of results highlight a labor supply and productivity channel, whereas it is the temperature affecting worker productivity. That's why we see a result in interfirm sales. Then the second mechanism is the financial constraints and adaptability channel, which I really like. So the idea behind this is, suppose I'm a firm. If I do not have the capacity to adapt, say if I'm financially constrained, or if I don't have the operating flexibility, then subject to this shock, I can't do any things to mitigate the change. But if I have the resources, then maybe I can increase the amount of temporary workers so that I can just boost my total output level. Then I would not be that affected. So the hypothesis here is that we expect the negative effect of temperature to be more pronounced for firms with financial constraints and for firms with lower operating flexibility. So we do this analysis in two panels. The first panel are measures for financial constraints, and the second panel are measures for operating flexibility. So the first split is really to split by the proportion of long-term debt maturing in the coming year. So this variable is saying how much of my long-term debt will mature in the coming year. So when it matures in the coming year, then as a firm, I will have to reserve some liquidity to pay off the principal and interest, and this lowers my financial flexibility. So in this regard, we do expect firms with a higher proportion of long-term debt maturing to be driving the results because they just can't adapt to this productivity shock. And consistent with this conjecture, we do find this result, and the magnitude is actually very strong. It's 2 to 3 times of the baseline estimate. Then when we look at firms that are less financially constrained or with higher financial flexibility, the results are really not there. Then we repeat the exercise. This time we use a easier to understand measure, which is whether a firm receives a credit rating by a credit rating agency. So if they are non-rated, then they are more financially constrained and they just can't use short-term funding to mitigate, to say increase the number of temporary employees. So what we expect is that non-rated firms should be driving the results, and this is also what we find. And we do not find much effects going on for firms that are not really financially constrained. So let's move on to operating flexibility. So the first measure we have in mind is firm size, because the larger the firm it is, we should expect they have more resources. So we expect firms with lower total assets to be driving the results, whereas firms with higher assets to be less affected. And this is also what we find. And again, the magnitude is really high. It's 2 to 3 times of the baseline estimate. So the second measure for this operating flexibility is whether a firm has just a single business segment or is a conglomerate. So the idea behind here is that we want to explore the role of internal capital markets. If a firm have multiple segments, then they have an internal capital market, and they can just pull resources from less affected segments to more affected segments as a way to adapt to the productivity shock. In other words, we expect that firms without an internal capital market, they are less operationally flexible, then they will be driving the results and the reduction in firm sales. And this is also what we find. So together, we argue that this set of results highlight that the role of financial constraints and adaptability is very important in understanding these results, and the capacity to adapt is really something that that highlights whether there is an impact of local temperature on interfirm sales. Then the third mechanism we have in mind is the switching cost story. So the idea is that if the So suppose I'm a supplier, I get shocked, and then I just can't produce as much. Then if my client can easily switch away from another supplier, then my reduction in productivity will have an amplified effect on interfirm sales. So the hypothesis we have in mind is that the negative effect of temperature to be more pronounced for firms selling standardized goods and for client-supplier pairs with weaker relationships. So we have some measures that proxy for high and low switching costs. The first one is whether a firm sells standardized goods. So while we find that the coefficient of the change in temperature variable are both negative and statistically significant in these two subsamples, we do find that firms selling standardized goods to have a larger size of the coefficient, which is consistent with the switching cost story, because when you're selling standardized goods, then clients are easier to switch to another supplier. Now, to capture this product specificity idea, we split the sample using this patent measure. So the idea is that if I'm a supplier that produces highly specific goods, then I should have more patents. So if I don't have any patents, then my goods are more substitutable, it's less specific. So in this sense, we do expect firms with no patents to be driving the results, whereas firms that have patents that are selling more complicated goods should be less affected. And this is also what we find. Then third, we split the sample by the pair level distance along the mean value. So the idea is that geographical distance can noisily but proxy for business relationship. And we expect that more distantly located firm pairs means that the switching cost is lower for the client. And then it should be these firm pairs that are driving the results. And again, we do find high distance firms to be driving the reduction in firm sales. So together, we argue that this set of findings highlight that switching costs also have a role in local weather shocks affecting interfirm sales. So we have done a number of robustness tests. I'll just highlight the more interesting ones. So we have also repeated our exercise using postcode level weather variables, and that is all right. Then another hypothesis is, should we expect a linear relationship, or should we expect that local weather to affect firm sales in a quadratic manner? So to test this hypothesis, we have included quadratic weather variables, but then we find that the coefficient on the quadratic terms are insignificant, and the change in temperature variables, the coefficient magnitude as well as size does not change. So we think it's really operating in a linear manner. Then to really take into account the broader spatial correlation of weather variables, we've also clustered at state level, and that works fine. So there are some additional tests. So we have so far just been looking at this change in local temperature, which is kind of a smooth average variable. So what about extreme weather events? Also, because our key dependent variable is this change in log pair level sales, so it's really looking at the intensive margin. So what about the extensive margin? Does weather shocks break supply chain relationship in the United States per se? So let's look at extreme weather. So when we look at extreme heat events, it's very strong and statistically significant. So the coefficient of the heat event variable is negative and statistically significant across specification, and the magnitudes are high, ranging from 6.2% to 8%. So this means that if a heat event occurs in that location, then firms will sell 6 to 8% less. Then when we look at extreme cold events, it's even more dramatic. So if an extreme cold event happens at a supplier location, then it leads to a 30% reduction in interfirm sales. Now, these are pretty consistent with what we would expect, but then the caveat is that these are really extreme weather events, and by looking at the summary statistics, we know they are very rare. Now then, here are some results on the extensive margin. So basically here what we want to see is whether the change in average temperature will lead to termination in supply chain relationships, and whether extreme heat and cold events will lead to termination in supply chain relationships. So in the first panel, we are looking at the change in local temperature, and we don't really find much going on, which means that changes in local temperature don't really break supply chain relationships in the United States. Then when we look at extreme weather events, we do see a lot of positive coefficients, but then they are not really statistically significant except for extreme heat in one specification. So we think that extreme weather events seems to have some impact on termination on relationship, but then this is not super robust. So perhaps something else is going on. But in short, we don't find weather shocks to have much going on, to have much impact on termination of relationships. So
you have 4 minutes.
Oh, so I'm helping. So we're good in progress. So in conclusion, we have identified the effects of local temperature on firm supply, and we think this is something that is important because we're controlling for unobserved changes in demand. We find this effect is driven by 3 economic mechanisms. One, it's labor supply and productivity. Second, is financial constraints and adaptability. And third is the switching costs. We find that extreme weather events are more disruptive, but then we don't really find much going on the extensive margin. So this is basically what I have, the key results that I want to show you guys. So I thank you for your attention. I look forward to John's discussion and the Q&A, and I'm super happy to talk even after the conference. So thank you.
All right, thank you very much. The next presenter is Nora Pankratz from UCLA. And the title is Climate Change and Adaption in Global Supply Chain Networks. You also have 30 minutes.
Excellent, thanks a lot. 1 second while I set this up. Yes, so I hope you can see my slides now. Yeah, thanks a lot, first of all, Dong, for the segue. Thanks to the organizers for including this paper on the program. Really excited to present this here. And last but not least, also thanks to you as the audience for tuning into this session. All right, so this is titled Climate Change and Adaptation in Global Supply Chain Networks, and it is joint work with Christoph Schiller from Arizona State University, who's also here in the chat today. And my name is Nora Pankratz, and I'm a postdoc at the University of California in Los Angeles. Let me jump right in, but I don't think I'll manage to start without a link to recent affairs. So I think the current public health crisis, and especially the beginning of it, has made it very salient to what extent there is resilience in global supply chains to unforeseen events and interruptions. And what we do in this paper is to try and better understand both supply chain resilience and responses in supply chains to another looming threat. And that threat is climate change. So if we look into this from an industry point of view, and especially when we set out working on this paper, we started just looking around whether there was any evidence of this mattering to practitioners. And somehow it seems that practitioners were a little bit ahead of the academic community in this sense. So first of all, already in 2015, there was a survey by PwC that said that 50% of CEOs really named climate change, and not just climate change in general, but specifically climate change in the context of supply chains as a primary concern, and one of their primary concerns. Moreover, it was also obvious that that was already a topic that a lot of supply chain consultancies were busy with, but also insurance companies stressed as a potential topic and a potential challenge in the future to manage these skyrocketing expenses that are expected from increases in these distortions to supply chains. So what we then try to do is, sorry, I'm just going the wrong direction here. Okay, I'll do this way. So what we then try to do is link that to the academic literature that was out there so far, and we set up our research questions in this way, broadly relating this to 3 different strands of literature that were already existing. So first of all, while there wasn't much evidence, actually hardly evidence at all, on the indirect effects of climate shocks to firms and financial performance, there was this fast-growing literature, I think largely also fostered by the RFS call on climate change and finance, that investigated to what extent firms are directly affected by these hazards. And I think also Adrian's really nice presentation links into that. But so there were already studies out there on, for example, the effect of temperatures on firm performance, both in economics and in finance. Moreover, we found that there was a broad literature generally on the propagation of any type of shock in supply chains. And particularly one paper that we refer to a lot, that's a really nice study in the QJE by Barou and Sauvagnat from 2016, that was studying the propagation of natural disaster shocks in supply chains. And so in that sense, the first step of our study, or the ambition for the study, was to put these 2 things together and look into how climate-related shocks that maybe might not make the news as a natural disaster propagate in supply chains, and whether we find evidence for a financial propagation, so to say. Okay, but then potentially even more importantly, and I think very much the focus of this paper, both in the version that is currently out, but also in terms of an update that we're currently completing, is related to another strand of literature. And that is something that has been predominantly developed in environmental economics. And I started off here with a really broad question. That would be the question of how do economic agents actually learn about climate change and how do they respond? And putting this into the firm, finance, and supply chain context, that essentially means, okay, so if we see this propagation of shocks, as financial economists, we might expect that firms respond in some way. And so that's something that we try to better understand here, to what extent there are responses in the formation of supply chain networks, if there's any chance in underlying climate risk exposure. And with that, let me take to the actual research questions, as well as the spoiler of the results that we're going to go through in the next 25 minutes, I guess. So again, we have these broad 2 questions that will be the guiding questions of this presentation. So first of all, do we find evidence that climate change related shocks propagate in supply chains? And then second, if we take that as a potential financial incentives of firms to do something about that, what do we see? Do we see that firms adjust their supply chain networks when shocks become more frequent? Or is there, say, not enough evidence for something like that happening at the moment, potentially given the extent to which changes in the climate have already been realized? In short, what we find is the following. So first of all, we find that both floods and heat waves, so those are the 2 types of shocks that we decided to study here, affect both directly suppliers' financial performance, as well as this performance of a customer that's located remotely in a different location. And we find that this propagation is kind of substantial if we compare both this direct and this indirect effect. For heat, the propagation is smaller, so only 10% of the initial effect are passed through from the supplier to the downstream customer. And for floods, that's a little bit more, or a larger effect, close to 30%. Moreover, we then go away from, say, these estimated short-run elasticities and think about, okay, what happens if there's a change in the perceived distribution of climate shocks? And the main result to stress here is that we find, if we investigate the supplier locations and we compare the number of realized flood days or heat days at the location of the supplier, not by itself, but compared to a benchmark of what could have been expected by the customer firm in the beginning of the supply chain relationship, we find that it becomes more likely that customers end these supply chain relationships. And again, so to say, in a proportion that holds or is in line with our estimations on the first stage of the study. So we find that for heat, customers become 11% more likely. And for flooding incidents, customers become 23% more likely, compared to the baseline probability to replace their suppliers once there is this difference between their experience with climate shocks and what they could have expected at the beginning of the supply chain relationship. We have one more piece of evidence on that note. So actually this data set also allows us to identify not only the terminated supplier, but also the potential or very likely replacement of this initial supplier. And then what we do is we compare the exposure to climate risk of this initial supply as well as the replacement. And we find that it looks like there's a higher probability that once a supplier gets terminated for reasons related to changes in climate risk, it becomes more likely that the new supplier is less exposed to climate risk. Yeah, and so while this is the wrap, so to say, of the main results in our study, I think one thing or one theme that is important to go into is, again, this broader topic of learning about climate change and how firms make decisions related to climate risk. And the really interesting thing that we find here in this context is that while these two results might suggest that firms are really aware of climate change and consciously manage that, we find quite strong evidence that they actually do that just learning on their experience with climate shocks and to some extent ignoring what's out there in terms of information and projections of actual change in the future. And I hope I get to that later on, so more of that later in the talk. All right, so with that, I hope I've given you a good sense of direction in this presentation. Let me quickly walk you through the main components of the data that we compiled to make all of this possible. So essentially, there are three really important components. The first one is probably unsurprisingly the data on supply chain relations. So the data set that we use here is FactSet Revere. So that's a global data set on relations between customers and suppliers. And it should comprise the public disclosure, for example, 10Ks in the US on the existence of these relationships. However, on top of that, FactSet analysts also collect data from other sources. So for example, other firm-specific reporting, news, and so on and so forth. And in total, we observed something like 25,000 pairs between customer and supplier pairs in this data set. And then what I would want to draw your attention to next is this map here, which shows you the distribution of these suppliers. So first, I think this is nice to look at just to illustrate that this is truly a global data set. But then second, it's also a really nice segue to one of the main challenges in not only this paper, but this literature in general. And that is related to the measurement of firm locations and the connection to physical climate risk. So what I mean by that is the following. Here, what you see plotted in this picture is actually the headquarter locations of these firms. Of course, headquarter locations, there might be a gap between that location and the main location where firms operate. And we really have to make sure that we come up with a reasonable link between the physical risk and the location in order not to unnecessarily bias our estimates or get noisy estimates here. So I think there are two things to be said about that. I mean, first of all, you can think about the ideal solution to that problem or the ideal scenario. And I think that scenario would be that we would have information at hand on all of the firm locations, but not only that, but also data on how we should think about the weighting of these locations, how they relate to each other, so that we could come up with a sophisticated way to really measure the weighted exposure to climate risks. However, especially in this global context, this is extremely difficult. So what we can do here as a next best solution, and which is also the approach that we're taking to solving this problem, is we collect all data we can find on the location of establishments, subsidiaries that are fully incorporated, branches, all types of locations that we could think of. And in total, that's a number of 1.1 million for all of these, I think a little less than 8,000 supplier firms in our sample. And what we then do with that is we create a measure how many of the facilities per firm are located within a radius of 30 kilometers of the headquarters. And then we use that measure to at least exclude data points from our sample where we can say, okay, if there's less than 1 in 10 facilities or establishments from locations within this radius, then we decide to exclude this observation just to make sure that we don't unnecessarily increase the noise in the sample by including data points where we actually have very little control over where operations actually take place. All right, so that much to be said about the distribution, although maybe I want to add a note just because that's a question that also comes up very frequently. So of course, we're mindful that there's a lot of heterogeneity in these relationships in terms of the industries. I think we have a focus in this data set on manufacturing firms, roughly 2/3 and 1/3 in services. We explicitly exclude financial services just because we thought in that sense it's very unclear what the traded good would be. For the rest of the presentation today, I'll present you the average result across all of the industries that we retain in the sample. However, again, just to stress that of course these heterogeneities matter, and especially in a new version of the paper, we try to also incorporate that in a meaningful way to illustrate how this might differ based on the industry a firm operates in. All right, but with that, on to the next really important data block here, and that is the exposure to climate risk and how we want to measure that. Yeah, so first of all, again, so we decided to study two different types of shocks here. First of all, heat and then inundation. We will be a little bit less focused on what the exact channel is through which these matter, but just again as a so to say quick summary of the literature. So for example, for heat, there are some productivity effects at the firm level documented related to heat, definitely with large standard errors, but there are a couple of papers in this literature that indicate that that is something that is to be expected on average. Moreover, there's a micro literature on, for example, the risk of injuries at the workplace, as well as traffic accidents under heat, and that there's a positive relationship between temperatures and such risks. And moreover, for example, also in Europe, it might be interesting to think about other transportation channels. So since often heat is correlated with drought, there are effects, negative effects on transportation, just if river levels drop too low. And in that sense, the transport of goods has to be kept, thinking about everything related to transportation on waterways. For inundations, I think the channels are a little bit less debatable. So water in your facilities is probably not helpful for production. But again, there might also be second order effects here, something like infrastructure that is affected or affects how workers can get to work. Okay, and how we measure that is indicated below. So first of all, for this global data, we use the ERA 5 data set. That's a 30 times 30 kilometer roughly grid of daily maximum temperatures. We choose to focus on the daily extremes just because those are indicated to be most important for productivity effects. And there are lots of different definitions possible. So we work both with absolute and relative thresholds in the new version of the paper. However, our main measure here is the number of days during a financial quarter during which the firm was affected by temperatures over 30 degrees. Moreover, for floods, we use data from the Dartmouth Flood Observatory. So that's a combined data set on hand-drawn polygons of areas that have been affected by floods, as well as remote sensing sources. And how we use that data essentially is to create an overlap between the location of firm assets and these floodings to create an indicator whether firm operations may have been affected by these incidents. And then finally, a new addition to the data set is that we also incorporate projections. So we go with the CMIP5, that's the data corresponding to the last IPCC report and mainly focus on the business as usual scenario for mid-century. And for now, we mainly go with the models of the Max Planck Institute. But on that note, I think it's most helpful if I explain later on, once we get there, how we incorporate this data. All right, I have to go back one slide once again. So what I've shown you now is, first of all, the data on supply chains. Second, the data that we have at hand on climate risk exposure. I think in the beginning, I announced 3 different components. So the third component does not have a dedicated slide here. And that's essentially referring to the financial performance data that we need. What we use here is the world scope data set, which is also a deviation from our initial version where we used the CompuStat data, just because in writing this first version of the paper, that was a little bit more convenient. But we then found that world scope would give us or triple the size of the data set at hand. And we were really comforted, or so to say, it gave us a lot of confidence to see that the results really hold and stayed very similar across both these data sources. All right. But I think that was complete. So those are the 3 main data components that we need. And with that, let me take you to the estimations and methodology, or the other way around, methodology and estimations. So first of all, what you see here is basically the baseline of the study and just this motivating stage of asking the question, do the shocks or the financial shocks related to heat waves and floods in terms of heat days and flood days, do they propagate in supply chain networks? And the methodology we use here is fairly standard. So on our left-hand side, we have the performance of a customer firm that is not located in the same place as the supplier. So we make sure that that is the case by imposing a geographical distance between the two. And then we test whether climate shocks, as well as 3 legs of these climate shocks, quarterly lags, whether those have an effect on the performance of the remotely located customer. And on top of that, we control for a couple of potentially confounding economic trends. So what you see here is, for example, trends over time by industry, trends over time by types of firms, as well as a location-specific fixed effect that just leads to us analyzing only the random variation around a location-specific average, which is really important here for the identification because, of course, we observe all kinds of places around the world, and there might be a confounding correlation with purely cross-sectional correlation with temperatures and locations. So here we focus on the within variation only. Okay, and with that, so basically what we do is we implement this methodology, and what I'm showing you now is the result of doing that. So we find, in short, that both heat days and flood days negatively affect the financial performance downstream in supply chains. And what I decided to show you here is just the picture for heat days. So we find that this effect sets in with a little bit of a lag of a quarter, but then both revenue over assets and operating income over assets are slightly negatively affected by these shocks to the supplier firm. And again, we ensure that there's a physical distance between the two, as well as calculate the difference between these indirect and direct effects if we compare the direct shock to the supplier and the shock, which you see here, indirectly to the customer firm. Two other things to highlight about this would be the following. First of all, if we look into flood days, this effect is much stronger. So this also, again, gives us some confidence that what we're estimating here makes sense. So the size of the effect in flood days is at least 5 times as large. Moreover, maybe it's important to highlight that what matters here for the rest of our study is maybe even less the financial magnitude of this, which is substantial, but not the determinant, just because, of course, there might be short-term adaptive behavior of firms that kind of buffers this, or operational risk management that leads to a smaller shock in financial terms. However, I think all of these results are indicative of distortions in supply chains caused by these climate shocks elsewhere. All right, I think there would be a little bit more to be said about the economic magnitude. Maybe happy to talk about that later if that's of interest. Otherwise, I would say I'll move on to this maybe most interesting part of the study. And that is the part where we focus on, okay, what happens? How do these firms respond? And is there any adjustment in supply chain networks? So I think it's really important to lay out here that we think about that in the context, or say backed by some conceptual framework that is largely developed by a paper by Kelly et al. In 2005. And why that is important is the following reasons. So first of all, we start from the intuition that customers aren't completely naive. Actually, it's really costly to pick up supply chain relationships, and often there are specific investments that have to be made. So that is not an easy decision to be made on the firm level. And we assume that customers have some information on the ex ante probability of climate shocks occurring at the supplier location, as well as some knowledge that a lot of these shocks is determined by a stochastic process. So what really matters for the choice of these relationships is actually the average exposure and not the realization of every single shock. Moreover, we assume that customers may trade off the exposure to climate shocks and other factors, such as the input costs at certain locations of supplies in making these decisions. And what I mean by that is that we observe this correlation between the economic development of places and the extent to which they're hit really hardly by climate changes, or at least the projected change. And that leads to a situation where a place that is more risky in a developing country might still be attractive if that is reflected in the input costs, but in some sort of competitive framework, we would expect that every firm optimizes this decision and kind of trades off these two aspects. So in that scenario, I think it's really important to highlight that we would not expect that there should be any effects of short-term changes or short-term shocks in heat or floods on the continuation of supply chain relationships. Just because, again, there's an underlying stochastic process. In a sense, it would be really irrational to terminate relationships just with a short run changes around the mean exposure in a certain place. However, we would argue that if there has been an optimization in place that trades off the average exposure and the input cost of this specific supplier, then a permanent change and a shift in the distribution of these climate risks could render a previously optimal choice of a supplier suboptimal. To kind of say the same thing, we created this figure here. So maybe let me quickly show you how the figure connects with this intuition that I just explained. So if you look at that, what you see here is a supply chain relationship, a hypothetical example. And if there is a customer firm that is deciding to work with a certain supplier around T equaling 0 here, then we assume that this customer looks back in time and comes up with a historical estimate of the expected climate risk exposure in this place. So this is very consistent with these other studies on learning about climate change in the environmental economics literature. And then going into the relationship, we start off with a setting where we think that firms may do something that's very consistent with Bayesian updating and that they mainly learn from their experience. And then what I mean by that is essentially that going into the relationship in every period, the firm learns about signals in terms of the realized weather conditions, in terms of floods and heat waves, and can kind of compare the actual realized variation to what's happened in the past. And then we create an indicator or a running measure of what happens or when the point sets in where there's a deviation between this past expected exposure and the actually realized exposure. And again, in line with this assumption about this optimization and trade-off of input cost and risk at a supplier location, we would assume that this is the thing that can trigger the disruption of supply chain relationships. So much about the empirical strategy and well, first of all, the intuition of the empirical strategy. The corresponding empirical strategy looks something like this. So we study the end of supply chain relationships. So in a panel, one in the last year of the relationship being active. And then we study what effect there is of this deviation between realized and expected climate shocks. Again, controlling for a lot of different trends. So for example, to pick up trade effects, we control for supplier country times customer country times time fixed effects. And data actually allows us to do that in terms of the variation that is available. And I think those controls are really important to give us comfort that what we see here is really about the climate conditions and not about potential confounding trade effects or treaties or something like that coming up. Another thing to be said is that we decided it would be convenient to start from this assumption that firms only learn from experience and only work with, so to say, this experience measure and a deviation of the realized climate from the expected climate, because this is fairly randomly distributed. And that's something that we, to some extent, verify. Again, probably would be helpful if I go into that after the talk, if there's interest in that. But just in terms of this short run deviation, this is fairly randomly distributed. And that's one thing also that makes learning about climate change really hard, just because often these short run trends and medium run trends can deviate from what's actually expected to change in a given place. All right, but with that, so that is the empirical setup, so to say, testing this relation between the variation, to what extent realized and expected exposure fall apart. And this is the corresponding result. So what we find is that indeed there's a strong increase in the likelihood of supply chain relations to end once there is a deviation between these two things. And that holds both for heat days and for flood days. And again, we kind of find it reassuring that in terms of significance, that's very much in line with also the differences we find in the magnitude of the shocks that are propagated in the supply chains related to heat and to flooding. We do lots of robustness tests for that. For example, we estimate these periods where the expected exposure is estimated for, I think, 5 different steps between 5 and 15 years. And moreover, we also work with different measures of exposure. So we look at the days of exposure as well as the shocks over time.
Sorry, Nora, you have 5 minutes.
Excellent, thank you. I think that will work out really well, actually. So there's one more finding after that. But so first of all, again, to zoom in on that. So the baseline result here is that there's an increase in the probability if climate risk exposure at the location of the supply changes. Again, thinking a little bit about what that tells us about how firms learn about this. So first of all, this would be pretty much in line with the standard model of Bayesian updating, where firms primarily use their experience as well as a historically estimated prior. And in line with that, we also find that this effect increases with the size of the shock that we observe. So if we change this from an indicator variable to the actual size of the deviation, as well as when the signal is repeated, which in this construction of the measure doesn't happen extremely often. So I think on average, we find that firms experience this deviation twice over the relationship period. Okay, and then really importantly, this is something that I want to stress, again, linking to the conceptual framework underlying this whole estimation. So definitely we would not expect that there's any reaction to transitory shocks here, just because, again, we assume that firms are to some extent aware of this stochastic process and the transitory nature of these shocks. So in other words, that also gives us an opportunity to test to what extent firms really stick to this Bayesian framework here, and to what extent there might be some evidence for the availability or heuristic here. So just individually, if we regress just the occurrence of shocks on the probability of the supply chain to end, we also find a really small positive effect. However, that will be economically significant. And as soon as we sort of say horse race these two different ways to think about it, so this deviation and expected and realized risk, as well as just the contemporary shocks, we find that also in terms of statistical power, the effect really seems to be driven by this deviation in experience and expectation that might render the previously optimal choice of a supplier suboptimal. All right, so this is our baseline result, but then again, and this goes a little bit into the new version of the paper, so to say, so I'll try to not venture off too far on that end just because this update has been really recent. So, but I think what's really interesting and what we hence also decided we wanted to show today is that we can now look into to what extent this learning from the short-term experience makes sense if we combine this with data on the projections of temperature changes in certain places. And how we do that here is we use this models from the CMIP5 experiment that's tied to the last IPCC report. And we focus on the business as usual estimate just because we kind of need the upper bound of the effect. So assuming that firms might think, okay, or no, assuming just a scenario where there would be no policy intervention at all. And then what we can do is, since there's availability of this data on a daily level, so daily simulations, by European Climate Institute, we essentially come up with a measure of this projection that exactly corresponds to how we measure these shocks in terms of heat days during a financial quarter, in terms of the projection, and compare these two. And the first way how we do that is the following, because essentially our ambition here is to stay out of exactly thinking about how firms may use these different scenarios out there, what their assumptions are about policy stringency, what their assumptions are about the physical processes, so to say, they would be tied to changes in emissions. And we set this up in the following way. What you see here in this table is, again, a similar regression of the deviation of realized and expected heat days on the probability of a supply chain to end. But then if you look at the part that I'm circling here right now, you see the results for the full sample. And if you move to the right on the slide, you see this same result for the part of the sample where actually these climate models project no significant change in the number of days per year over 30 degrees Celsius. And yet we find that this effect is actually slightly stronger in magnitude, but also very similar in terms of direction and significance. And we take that as first evidence that it might be the case that firms actually update based on just their experience compared to a historical prior, and leave this information on actually projected change on the table. With that, let me jump to the next piece of evidence, so to say, on how this process works on the firm level. So far, we estimated just the probability of supply chain relationships to end. What we do next is to dive into how these initial suppliers are replaced. And again, the data makes this possible. So we can identify both the terminated supplier as well as suppliers that are in the same 4-digit SIC industry and where the relationship starts within 1 year of the termination of the initial supplier, so that we kind of suppose that those two actions might have something to do with each other. And most likely a large share of the sample is the actual replacement. And then what we want to see, just to get more insight into whether there's any climate awareness in play here or how firms think they manage this risk once there's a deviation of the experience from the expectation, is the following. So we want to avoid that our results are in any way confounded by potential trends in climate. And that could easily be the case as soon as we look into one supplier that has been in place earlier and compare it to a supplier that has been in operations with a customer firm later on. So how we do that is that we're very strict about comparing suppliers over the same time periods. So this is a hypothetical example, but just here we would compare the replaced supplier to the actual replacement during the relationship as well as during the new relationship. And what we find if we look into this comparison, and again, linking this to this measure of whether actually there might be an incidence that could have triggered such a supply chain disruption induced by climate shocks and change in climate risk, we study whether the probability of a decrease, so the new supplier being less exposed than the old supplier, is driven by this condition that the termination might have been climate risk change induced. And again, we control for a really large set of fixed effects here, again, to address this potential risk that this is not purely random, this variation, and that there might be confounding effects from trade treaties and trade in general. Probably I'm slowly running
you
out of
are.
time, but I think this is also the last result. So what we do find is that during the relationship, it seems like the new pick is actually a very good pick, just because the decrease becomes more likely, so that the new supplier is actually less exposed. However, again, in line with this fact that maybe firms are not really forward-looking in doing this, once we look into the relation between the two after the initial relationship, we find that there's no significant difference. And with that, I'll conclude. So in a nutshell, again, we find some evidence, maybe the upper bound in terms of the financial outcome that we see of potential distortions in supply chains. We find that climate shocks decrease both suppliers and customer revenue and operating income over assets. And that connects to both the propagation of shocks in supply chains, but also as an indication that is important for finance in general, that maybe these shocks are not as idiosyncratic as you could think if you don't think about the trends of climate change in the first place, just because there's a propagation of climate-related shocks in these firm networks. And moreover, we find that customers are more likely to replace suppliers when this realized climate exposure deviates from the expected shocks. Again, highlighting here that this is very different from thinking about just the effect of transitory shocks on the continuation of supply chain relationships. And interestingly, it seems like forward-looking information might not be driving these decisions. And that, again, is in line with the literature in environmental econ on learning that stresses difficulties in, so to say, combining both the experience and the forward-looking information. Thanks a lot for your attention, and we're looking forward to your questions and comments.
All right. Thank you, Nora, for the presentation and for joining us at a very early hour from LA. The discussant is John Hassler from IES at Stockholm University. John, you have 15 minutes.
Thank you very much. Thank you very much for allowing me to discuss these interesting papers. So I'm going to start with just a very short recapitulation of the contents of the papers. So Adrian's paper is, both papers are actually about supplier-customer relationships. And this is an interesting topic that I haven't read much about before. So I like that a lot. So Adrian's paper is about the consequences of weather events on supplier-customer relationships in the US. And they get a couple of interesting findings. In particular, what they find is that an increase in the average temperature of a particular year relative to the long-run average reduces supplier sales significantly, statistically and economically. So think of this as if a particular year is hot relative to the average in that location, then sales goes down. They do not find any effects on supplier-customer link breaking probabilities, and that's a little bit of a contrast to Nora's paper. But of course, it's different data, so one doesn't really need to think that they should get the same results there. Since Nora's paper is about kind of international supplier customer links, so this Adrian's is on the US. What Adrian also finds with his colleagues is that you get stronger effects on sales in labor-intensive and small firms, and also firms that we think might be financially constrained. So that's also an interesting finding. And they also find that the effects are larger in sectors where we seem to have some reason to believe that they are more heat sensitive. And there are some papers studying this previously. And as Adrian pointed out, it kind of seems to have to do with whether a substantial part of production is taking place outdoors or not. So that seems to be kind of reasonable for agriculture, paper and forest maybe, but maybe some of these industries are kind of, it's a little bit hard to understand from the paper why they should be heat sensitive. So that's one point. Okay, so that's a very short description of Adrian's paper. Now let's go to Nora's. So as I said, it's also here weather events. They are defined a little bit differently, as you heard. It's not kind of the average temperature. First, it's both about heat and about flooding, and it's more kind of an event here is defined as some extreme realization of temperature or flooding. And what they find is that both these floods and heat waves decrease suppliers and also customers' revenues and profits. And here they find that to be statistically and economically significant. They do not find directly that floods and heat waves to suppliers, if you just put them into the regression and try to explain where their links between supplier and the customers are breaking down, if you just put in these things, these events in the regression, there is not much of an effect. But as Nora pointed out, if the number of shocks, floods or heat days in a year is higher than the historic average for that location, then the share of links breaking up increases substantially. So it's kind of this deviation from what you expect, as Nora pointed out. Another, I think, very interesting point is that when a supplier is replaced, and arguably for having then seen a lot of these weather-related shocks, then it seems like the replacing the supplier that replaced the old one is less exposed to these kinds of weather shocks. Okay, so the statistical analysis and the data is interesting and surely competently done. So I'm not going to spend too much on that. I just want to say that I think it's very important to do these kinds of studies. We certainly need to know much more about the costs of climate change. I do the macroeconomics of climate change, and we really need these kinds of inputs. But I'm a little bit, questioning whether all the results really are about the cost of climate change. First, a simple thing is, of course, to say that what we need to know is kind of aggregate costs. If we are talking about the inputs into discussions about what kind of policy we need to aggregate. That maybe it's kind of the job of us macroeconomists, but nevertheless, I think that's something that should be kind of maybe thought of in papers like this. In any case, this aggregation should certainly be kind of based on micro studies like this, for sure. When you do these kind of things, it's also, I think, interesting to try to be to say something about quantities. Are these risks large relative kind of to other kinds of risks that firms faces, and in particular when we talk about climate change, risks that kind of develop over a very long time, and to me my gut feeling is that these are not large risks, but I think that's important actually if you want to contribute to the climate change literature, to take that discussion seriously. Are these things large or are they not? It's also that I think that we kind of need to think a lot about what kind of questions can be answered with data like this. And let me just take maybe a simple point here about that, and that is that both papers kind of use, in a sense, similar empirical strategies, but one talks about weather shocks and the other about climate shocks. I think you're actually talking about the same thing, and it's and perhaps it's obvious, but weather and climate are two very different things, and I think that needs to be kind of thought of more in studies like these. So weather is kind of the an event, right? But climate is kind of the distribution of these kinds of events. So mean, standard deviation, maximum temperature, wind speed, and precipitation. And when we talk about climate change, we talk about changes in these characteristics of the distribution of the weather events. And it's a very hard task to think about how we can identify effects of climate change from looking at weather events, and it's a difficult issue. But I urge everyone to kind of to take that serious and at least think about it, because I've seen papers where this is not taken seriously at all, and the effects of weather events are just extrapolated for decades into the future. And to me, that makes absolutely no sense at all. So always make a clear distinction between weather events and climate change. And this is because we have all the reasons in the world to believe that there are differences in the way weather affects payoffs and behavior, and the way climate change affects payoffs and behavior. We have, I mean, for example, we know that deviations in temperature from kind of the average affects humans' health, but kind of what's the optimal temperature from a health perspective seems to vary a lot across different locations. So this, I think, is an important point. And as I said, this is difficult, but nevertheless, it's necessary. So I'm going to end with just some kind of very kind of rudimentary or simple thoughts I had about how informative the weather shocks that you use are about what we're interested in, namely climate change, the effects of climate change. So in Adrian's paper, what you use there is that you say that sales falls what seemingly linearly in temperature deviations from the normal in that region. But what climate change is going to do is that it changes what's normal. So it's so here this issue comes up, and it's not entirely clear to me why the results should say something about how firms, for example, profits and sales change when the normal changes. By construction, in a sense, the effects of the normality are taken out. And another thing is that the finding that the effects are linear also implies that if we are worried about increases in the variance of weather, I'm not sure actually that there is much of evidence that the yearly variation in temperature is going to be larger in the future, but perhaps. But nevertheless, the linearity here implies that the standard deviation is not going to change average sales. You need some non-linearity for that to matter. But here your extreme event analysis, of course, provides important evidence. So the extreme event analysis, I think, clearly could provide evidence about, it could kind of identify the effects of climate change, while the others maybe not. At least I think you need to kind of to push that harder. Nora, what you find, an important finding in your paper is that if you have more than the expected number of weather shocks, then you get effects. and in particular for the breaking up of the links. But here again, kind of you take away the effects of the changes in the expected number of shocks. So here it's also not, to me, obvious that this really identifies the effects of climate change. On the other hand, this thing that you stressed in the end, that when firms are changing supplier, and in particular, if you can argue that those changes are due to there having been more than the expected number of weather shocks in the past, these new replacing firms are located in areas where you have where you are likely to have fewer weather shocks in the future. That strategy, I think, could potentially be valuable if you want to identify the effects of climate change. Of course, the problem is that there might be other trends, and you talked a bit about it, that confound these findings. In any case, so my conclusion is that these are quite interesting and very competently executed papers, but this issue about how should we identify the effects of climate change as opposed to weather events, it would be very useful if micro people like you think about that and provide some insight to us as macroeconomists. Okay, thank you.
Thank you very much, John. Since we are a bit over time, so I suggest that we take a break for 5 minutes before the keynote. And in the meantime, we'll keep the discussion open so that if any of the authors want to respond, you could just go ahead. Right? And the keynote speech starts from 5:05.
Hi, John. Thanks for the discussion. It's very, very helpful, very thought-provoking. So
thank you.
I'll think very properly about this, and then maybe if we can chat offline later, that would be great.
Hello.
Thank you, John.
Did I lose you, Adrian, or you wanted to speak later? Maybe I didn't hear exactly.
Yeah, that would be great. I'll send you an email and see.
Yeah, great.
If it's your schedule better.
Great.
Thanks. So, it's very helpful. It's a lot to think about.
Thank you. Yes. Let's send me email and we can chat about it in the week or so that comes.
Yeah, I'll just send you an invite. Thanks a lot.
Sure. Thank you.
I'll just go and get some refreshments and then come back for the keynote. Thank you.
Hello, Harrison. Are you ready for your keynote speech?
Yep, no problem.
Yeah. Okay, so I will make an introduction before I hand over to you. All right.
No or no? Okay.
Sorry?
Yeah, go ahead. Sorry.
Yeah, okay. Welcome back, everyone. Let me introduce our keynote speaker, Harrison Hong. Harrison is the John Acol Jr. Professor of Financial Economics at Columbia University. He received his PhD in economics from MIT. Before joining Columbia, he was the John Scully 66 Professor of Economics and Finance at Princeton University. And he has contributed to a number of topics in financial economics, especially on behavioral finance and stock market efficiency. His work on disagreements, bubbles and crashes, friction arbitrage, and corporate sustainability and climate change risks have been published in different top economics and finance journals. So today, Harrison is going to give a talk about mitigating disaster risks in the age of climate change. Harrison, we have 40 minutes. Maybe you can talk for 35 minutes and we have 5 minutes for questions.
Great. Thanks a lot, Dawn.
All right, the floor is yours.
Thanks for everyone for sticking around. I put a talk together that is predominantly based around some new work I'm doing with Nang Wang at the Columbia Graduate School of Business and Jinchan Yang at the Shanghai University of Finance of course, on disaster risk. But the talk itself, I'm going to try to be a bit broader than that paper and just reflect on this very horrible year that we're all living through. I mean, obviously, you have the pandemic, and I think in the US, for the second year in a row, the Western US states have these wildfires, and I think we're currently going through in the Atlantic, probably I think we're going to break the record for the number of hurricanes this year. So let me start with just a statement that, I think in the last few years, climate scientists have, I think, predominantly now converged on the view that climate change is making weather disasters more severe, and that, going forward, it's likely going to be even worse. So, if you look at the last couple of papers in the PNAS on increased frequency and severity of Atlantic hurricanes, I read some papers in 2005. I think there was a lot more debate, certainly about the frequency, whether or not climate change was leading to global warming was leading to kind of more frequent Atlantic hurricanes. But I think that ship has now sailed. I think there's now basically more consensus that you have potentially some pretty bad states out there in the future if there's no mitigation or if there's no if global temperature is not controlled. Certainly in the Western US wildfires, there's now pretty good evidence, especially in the states of California, Oregon, and Washington, that these droughts that are linked to climate change are having a pretty severe consequences for these US wildfires. And we know that from models of disasters in macro, that the welfare loss of such events are likely to be high. So just think about typical tail hurricane events that in the Atlantic, kind of some extreme events are like 1% to 2% of Atlantic housing stock, right? Once every 40 years. And if you look at kind of the models that Barrow and my co-author Nung has done with Pindyke, these sorts of disaster models can generate a pretty high willingness to pay to avoid these disasters for two reasons. And first, the shocks are permanent because they'll destroy some capital. So think about hurricanes and wildfires, for instance. And second, of course, are risk preferences that I think if we take seriously some of the stuff people have done in macro finance, risk preferences plus the permanence of these shocks suggests pretty high welfare losses going forward. And I think kind of our entry into this is that, and I think climate scientists kind of understand this, is that I think most of our preoccupation of thinking about climate change research has been, and I think rightly, on emissions control and carbon taxes at a global level, which are of course very important. But at the same time, even if these things were implemented, you would still basically have many decades where you have to still deal with these disasters. I mean, it's not as if emissions control is going to suddenly turn the world back per se, in a very short period of time. And so our view is that, probably more research. I think it's, relatively speaking, more research needs to be done on regional level disaster mitigation and thinking about the costs and benefits of that going forward, because, it's going to, these sorts of mitigation activities will likely play a key role. Okay, so there's some key questions that we'll try to focus on. So first is what determines mitigation, of course. Second is what are the welfare laws with and without mitigation. Okay, and I think that the contrast of the two is super important. And then finally, what are the tax and asset pricing implications? Okay. So this is the paper. It's still kind of undergoing some revision, but I think we're kind of converging on a draft that is readable. So this is sort of what we try to do. We're going to propose a model of regional level mitigation, where mitigation spending essentially limits fat tail damages to capital stock along the lines that I've sort of talked about earlier. There's going to be two features that we think are important in terms of quantifying these effects. So first is when a disaster arrives, that's going to change the perceived risk of households, and that's going to change then the value of mitigation. Okay, so I think one of the things that's important to point out is that going forward, as we do these calculations and trying to figure out welfare laws, I think there is naturally going to be a lot of learning by society going forward. Just look at the last 10 years, for instance. And I'll talk a little bit about that. I think that the scientific consensus on hurricanes in 2005, as I said, was mixed, but the last 15 years or so, that consensus has changed as more evidence has arrived to inform and to refine the climate models. Second, of course, the model also features, and I think this is important, an under-provision of mitigation in competitive markets due to externalities. John Hasler, who's discussed in earlier papers, has done sort of important work on this in the context of emissions controls. There's going to be a similar notion of externalities when it comes to the provision of mitigation, such as seawalls, et cetera. Okay. So what we're going to use the model for is to quantify. I'm going to do an application. The model is fairly generic in the sense that it could be applied to a number of different scenarios. But just to make things very concrete, we're going to focus on quantifying the value of mitigation in terms of seawalls to guard against more frequent Atlantic hurricanes. Okay, so I'm going to imagine the model is about these Atlantic hurricane states, which is about 40% of U.S. GDP, and so that they realistically need to deal with these issues going forward. And we calculate, and we're going to focus particularly on housing stock, just to make things much more concrete again. So we calculate some willingness to pay to avoid hurricanes, something on the order of 25% of housing stock, and I'll talk about the scenarios that we're calculating. The value of mitigation of these seawalls is about 15%. So that is, you're going to do significantly better, essentially, with these mitigation activities. To fund the seawalls, it's going to be 1.5% of the housing capital tax to fund the mitigation. Is on kind of an ongoing basis, an annual tax on top of whatever, of course, taxes that. And the Atlantic coastal property in a competitive setting is about 8% too high compared to the first pass. Right, so that's kind of the economics I'm going to articulate in this talk, and then I'll try to use some of these numbers to guide some of the recent work on trying to understand the relationship between housing prices in these codes and climate risk. All right, so there's, I think sort of the broad goal that we want to do is related to some estimates that, and certainly this is in the literature. So if you read scientific journals like Nature and Science, there are a lot of estimates about these long-run damages associated with these disasters. So in that sense, we're not going to be the first people to give you some estimates. But I'm going to point out, I think, a few things that are very, very important. So let's take probably among the most famous of the papers is the Shang-Gina paper. So they basically, the way, and I think typically most of the science papers model weather disasters, it's along something like a productivity shock that affects long-run GDP growth. Okay. And I think this is kind of the wrong model, actually. Certainly it's the wrong model to think about the US. It could be okay model for thinking about developing countries, because, there, I think these countries there are probably more fragile, and I think there are these kind of long-run effects. But I view that, if you're going to want to quantify these sorts of disasters, these weather disasters, sort of a disaster model is a lot better than a labor supply model, where, some disaster affect long run labor supply and affect like long run growth, productivity growth. I just don't think that makes, I think it's okay. It makes some sense, and certainly you can kind of get estimates from that. But I think it's generally useful to think about probably a more better model to match, I think, what's going on in the data. So, for instance, the developing countries, the Shanghai estimates are something like the mean estimate is $10 trillion globally, absent mitigation, and sort of what is called the business as usual thing. But of course, I think the other thing with these estimates is that the models of mitigation are not very good, right? Which is super important to understand, right? That typically most of these estimates, are not really so focused. They're mostly focused on the business as usual. So I think, there's some value in the estimate, but I think modeling the mitigation is actually fairly important. Okay, and as far as I can tell, there hasn't been too much work, I think, on linking mitigation to kind of getting these numbers. And in fact, in these models, in these estimates, the way people think about mitigation is that it's changing the path of temperature from a business as usual scenario, which I view as being pretty far away from what would realistically happen in a world of climate change, which is, you should think about building seawalls, you should think about land use regulation, et cetera. Okay. All right. So just to make things super concrete, this is a picture of the the primary kind of Atlantic hurricanes, which I've sort of recently read up on. So there's about 46,000 miles on the Atlantic hurricane because of all the jaggedness. There are basically low-lying areas at risk of sea level rise and storm surges. Okay. And so in the last probably 120 years, there's been about probably 2 major landfall hurricanes per year. Okay. And then the average of the top 6 most damaging hurricanes are about 1 to 2% of the housing stock in the Atlantic. So right now, let's just take that number to be about $17 trillion. Okay, and you can quibble with these numbers a little bit. NOAA produces these numbers. And my sense is actually on the tail events, the numbers probably are a bit higher because basically, the estimates are we know sort of from lawsuits after the fact that the numbers tend to become more higher than the official numbers. And here's sort of the mitigation strategy that's on the table, which are these seawalls. This is a picture the New York Times produced. So in New York City right now, we're thinking about a $119 billion seawall for about 6 miles. And so the seawall basically is a little bit outside. And I think this is the nice one. This is the one that I think the Netherlands use with some nice retractable gates and everything so that, you can kind of mitigate these storm surges, okay? There are other estimates, and of course, on the table is exactly what's called a high tide tax, like who's going to pay for the seawall for the Atlantic region. So there's a report out that has some other estimates for a seawall. They're a little bit cheaper, probably $15 million per mile. And if we just take these numbers and you amortize this, and I think typically there's some depreciation, so you have to spend 5 to 10% on maintenance on these seawalls. We're talking about proposals that are anywhere from about 81 basis points to about 4% of capital stock per year for these types of mitigation activities. Okay, so the question is, do these proposals make sense? How do we make sense of all these numbers, right? To relative to the risk that society faces. Okay. All right, so the model we're going to do will be the following. We're going to do an AK model. Some people in macro like it, some people in macro don't like it. I think actually for the purposes that we're doing, I think it's okay. So you can think about K as capital stock, as its housing capital stock, and what people consume in terms of output are these housing services, and A is some productivity parameter. So it's a typical AK model, except for one thing we introduced, which is X, which is this mitigation spending. So, with these output, you can consume, you can make some investments, you have to pay for some adjustment costs of capital. And then the big thing is really this mitigation spending X. You can also deploy some of it to have some of these seawall, okay? So the risk that the economy faces will evolve like this. So you're going to get your standard capital stock equation that evolves. You make some investments, capital stock grows. There's a little bit of some diffusion shock associated with. You might think some homes are just going to be outdated and you need to replace it. And then the big thing is really this DJ process, this is the Poisson process that arrives where a hurricane arrives, and then you're going to basically lose some fraction, 1 minus Z of your capital stock. Okay, so Z will be this recovery rate, and the way we'll kind of model the damage will be that Z is going to follow. This recovery fraction. It's going to have some cumulative distribution function and some density function. Okay, and so Z is going to follow some power law that we'll use to calibrate the data. Okay. So there's going to be two possible states of the world. So you can think about the good state as something maybe in the past, okay, where you're getting maybe 1 to 2 arrival rates of hurricanes per year, and the lambda B will be the bad state, okay, and these two states are absorbing states, and so there'll be some learning that goes on based on the arrival of these disasters about what state of the world that we're in. Okay. Otherwise, standard adjustment, capital adjustment cost function that's widely used, and the mitigation technology will work like this. So you're going to get some recovery fraction Z. The more you spend on mitigation, the more you get the recovery of your capital stock when a hurricane arrives. Okay, and the way we'll kind of parameterize it is in the following way: the density or the CDF of the recovery distribution is going to depend on your pre-jump spending, little xt minus. That's going to be basically just your mitigation spending divided by the pre-jump capital stock. And the way we sort of parameterize the function is that if the mitigation spending doubles, the benefit of mitigation also doubles, okay, which seems sort of reasonable. And then the domain of the recovery distribution, the recovery variable will be between 0 and 1. Otherwise, we'll use sort of the standard Epstein-Zine recursive utility. And as I'll talk about, this is predominantly very important because we want to get some risk preferences that we have a sense for as being sort of realistic. Again, the most important parameter here will be this side parameter, the elasticity of intertemporal substitution, which is mostly important actually for asset pricing implications. It's not so important for the welfare loss calculations, as I'll point out in a second. Okay. So let's talk about the solution. So first, you solve the filtering problem. The reason we chose, of course, this sort of a Poisson learning process is two things. First, it's going to keep the model fairly tractable, and second, we don't have to estimate any parameters when it comes to the other than basically picking what's a bad state scenario, lambda B. Okay, so the way that the filtering works is that pi t, which is really, this is the main state variable. When a disaster arrives, you're going to basically update on how likely now is the bad state. Okay. And so learning model, of course, is going to generate time varying stochastic arrival rates as far as these hurricanes. So the point is that in some years, you may think after a couple of arrivals, wow, the world is really bad. But then, maybe in some other years when arrivals have been less than what you expected, you might think maybe things are okay. This is all allowed in the model, right? When we do these welfare calculations. Okay, so you can kind of calculate pi as sort of a martingale. And so the way the updating works is, the second basically a disaster arrives, there's a jump in your state variable pi, but otherwise, when no disaster arrives, you're going to just deterministically drift back to your prior. Okay. So this is a picture of how the updating is going to work. The red dots represent the arrival of some of these hurricanes, and you'll see that starting at a prior 0.1, you start drifting down, and then suddenly when a disaster comes, you pop up, okay, and then you kind of drift down again, and then you pop up. So if there's a cluster of arrivals, you're going to then basically kind of move up fairly quickly in terms of the learning process. Okay, and this is completely rational and Bayesian updating in a world where, and this is I think kind of important and I think relatively new to the literature. Disasters are discrete signals. Okay. Therefore, this is the rational updating process. And kind of one thing to note is in the environmental literature, there's a lot of discussion of what's called overreaction after disasters arrives. But I think that sort of is a little bit misplaced because I think if people are updating on discrete signals, you should expect some degree, just rationally, of what you call overreaction in the sense that if no other disaster arrives, people basically drift back down in terms of their beliefs. But I'm not going to spend a whole lot of time on the learning. I think there's actually a number of interesting things in the learning model that would be very informative for learning, to talking about the disaster and environmental literature, but that's not really the main goal of the paper. Otherwise, you can write down your HAB equation. So the two new pieces, of course, is this pi state variable, and then, of course, the jumps, right, which will basically create this change in the value function. And this is where you get a lot of the bite when it comes to these welfare loss calculations. But otherwise, you get your standard investment, first order condition, your usual one. The only new first order condition we're introducing is basically X the mitigation, which is essentially you're going to choose mitigation such that you equate the marginal benefit of mitigation with the cost of consumption, of course. And the interesting thing is that basically by changing X, you're going to change the aggregate risk in the economy. Okay. So you can view this as a first order condition from the planner's perspective. And you can also view this as we've modeled mitigation as an externality in the sense that individual households are not going to want to do any of this stuff, right, because of this externality. Just to kind of make things a little more concrete, we'll model the recovery distribution Z as a power law. So basically it's going to be Z to the beta X. So X is controlling the beta, which is governing basically your recovery distribution. So a couple of key notations. L pi will be your expected capital loss per jump. Okay. And then G will be your growth rate. And so what happens in the economy is that when a disaster arrives, you're going to lose some fraction of your capital, right? And then your growth rate then, your unexpected growth rate then will just be your investment minus then how frequently these disasters arrive and the conditional loss per jump. How many jumps you have and the conditional loss per jump. So all the formulas are fairly nice and transparent, relatively easy to sort of work with. And then we're going to make things a little bit more for calibration and quantitative purposes. We're going to work with beta X as a linear function. So that then we only have to calibrate really kind of two parameters, beta 0, which is in a world without mitigation, and then basically beta 1, which is the mitigation parameter. Okay. And then for the capital adjustment cost, we're going to just assume standard convex adjustment cost. All right. And finally, let's talk about the value functions. So in this setup, you can still keep all the nice properties so that the model is essentially highly tractable. You don't have to deal with PDEs. You're mostly dealing with still ODEs. And you can get the value function for mitigation. The big thing is little b pi, which is the certainty equivalent with and without mitigation. So this is b pi and then b hat pi, right? And it's telling you basically how your value function is changing as your perceived risk changes with pi, both with and without mitigation. Okay. There's a market failure in the model. So the competitive equilibrium solution is not corresponding to the planner solution unless there's no mitigation technology that's available, right? So the welfare theorems don't hold in this model. And the SDF of the mitigated economy and the SDF of the competitive economy are not the same. Okay. So therefore, and the reason is just we model the mitigation as reducing aggregate risk, which itself is basically building in this externality. We have in the paper, of course, you can also basically make mitigation a non-externality as well. But I think the interesting thing for us is really the externality aspect that reflects sort of these seawalls and whatnot. All right, and then finally, we're going to calculate welfare loss. So there's just kind of two notions. So one is the welfare loss is, how much does your welfare change as your perceived risk changes, both with and without mitigation. And then the bigger thing we want to calculate is really the value of mitigation, right? So we can compare basically how much money would you really be willing to give up for mitigation. Okay, so this is zeta pi number. Okay, so we're going to be interested in calculating tau pi, tau hat pi with and without mitigation, and then the zeta pi. Okay. All right. I think for this type of models, actually, this is fairly, that's not that many parameters, so I can kind of talk you through it. So first thing is the elasticity of intertemporal substitution. This, as I said, this parameter is probably more important for the asset pricing than anything else. So we'll set it to 1.1. Probably a natural benchmark is something like 1. And in the long run, the risk literature guys try to jack it up to 1.5. I think our perspective is 1.5 is probably most macro guys will probably think it's a little bit too high, a little bit too crazy. Something around 1, maybe kind of okay. Then the power law exponent with no mitigation, we're going to set beta 0 to be 246. So what this means is you're going to get conditional on the arrival of, this is to match the fat tail of the hurricane distribution. So that, per jump, it's about a 40 basis points of damage to capital stock. So which is sort of reasonable given historical data. We're going to set, just to be conservative, we're going to set lambda G to be 1. So there's kind of one major hurricane in the past. This is like the good state. This is like the before climate change world. Right? And then, of course, climate change means we're still learning about where we will be. So I'm going to set lambda B to be 10 as sort of like the worst parameter you can think of. And then, of course, pi will moderate where we are in terms of how bad global warming is. Now, the time rate of preference, productivity, quadratic adjustment cost parameters, coefficient relative risk aversion, capital diffusion volatility, we're going to target these to match these moments of the risk-free rate, housing return risk premium, housing market volatility, expected growth rate, and Tobin's Q in the housing market. Okay. And then finally, the mitigation technology, the way we'll do it is we're going to pick beta 1 such that in the good state, you don't spend any money on mitigation. Okay. So that basically kind of tells you how, it helps pin down sort of how efficient is the mitigation technology. Right. Okay. So let's talk about the numbers then. So I think that's sort of the main point is to get some estimates of these hurricanes. On the x-axis is pi, that's our mainstay variable. Okay. First thing, let's talk about the red line. The red line is the competitive economy, okay, with no mitigation, right? Okay. So as I said, you know, we've calibrated so that one hurricane means about 40 basis points conditional on a hurricane is about a 40 basis point damage to capital stock on average. Of course, there's a fat tail. So if we think about the world as, you know, let's think about where we are right now in the world, which is maybe like a 0.2 or something, where we think, you know, it's bad, but, you know, maybe not super bad yet. You're still getting a pretty substantial drop in terms of welfare, right? So, you know, the red line you're dropping without mitigation is like almost 0.3 at a pi of 0.2. And then the growth rate, you're beginning to basically see growth rates now that will be affected because of these arrivals of these disasters. Now, if you mitigate, okay, you do a lot better, right? So, you know, at 0.2, your value of mitigation is something like, you know, 0.15. This is a zeta pi parameter. It's just telling you that, you know, you would forgo 15% of your capital stock, basically for some value of mitigation. It's just really the difference between the blue line and the red line. Okay, so. And of course, the value is that you keep your growth rate higher because you're basically mitigating against, you know, these bad tail events, right? So your conditional damage really drops a lot, essentially, right? It drops you from 40 basis points per hurricane to about, you know, 20 basis points per hurricane of capital stock. Okay, and agents with these Epstein-Zine preferences really value, okay, this type of mitigation. All right. So I think these are new numbers, just to kind of flag it. So what does that mean? You know, so if you're going to have 15% of 0.15, you can think about that as 0.15 of $17 trillion. That's sort of the value being generated by the seawall technology, okay, which I think is a kind of a new estimate that I think is where we're bringing to the literature. So now let's think about the other more finer aspects of the calculation. So X is the mitigation spending as a function of pi. X is also the tax rate. Right. Okay. So basically X pi is basically at 0.2. You're talking about like a 1% housing tax to fund the mitigation. All right. One thing to kind of interesting to note, right? So of course, because you're paying for mitigation, you're going to invest less. And of course, the externality here is that building coastal homes, right, exposes the aggregate economy to a lot of risk, right? So you should tax basically these homes and fund mitigation. All right, so coastal property then, of course, relative to the competitive equilibrium, is going to be too high. Right? Coastal property prices are just too high in the competitive equilibrium compared to the planner's equilibrium. So some of the numbers we have, just a few things. So the 1% tax is obviously non-trivial for a lot of homeowners. But what's interesting is that actually the implications for home prices, which is captured by Q, is actually fairly modest. And the reason that's the case, of course, is that when people talk about taxes and all of this stuff, they mostly say, oh my God, you know, I'm going to get a tax. They forget about all the benefits that the mitigation gives you, right? Which is, it severely reduces risk. it improves welfare quite a bit. And actually, the asset pricing implications are surprisingly, this is something we had learned in the model, because I think there's a lot of discussion in policy circles about all of the bad things that will happen to financial markets should you have some taxes. But I think that misses like half the calculation, which is there's also a lot of benefits associated with that relative to the unmitigated economy. Okay, but of course there will be some price effects, right? But those price effects have to basically be offset by the benefits associated with that. Now we've picked at the side. So these results is super sensitive to psi. Right? These results are not, because of the welfare results are not so much. But basically, these asset pricing results are super sensitive to psi. And I think we picked numbers that I kind of plausibly believe. So there's this, I don't think so basically what happens if you go for a very high psi 1.5, both lines will be really downward sloping. And I don't think that makes too much sense, I think, in this current context. I think that was used to mostly match the equity premium puzzle literature. But I find that that's sort of a different exercise. I mean, I think we learned something qualitative from the exercise, which is the importance of psi. But I think kind of realistically, this is probably a reasonable calibration. All right, so what are some takeaways for the empirical research? So one thing that the model does, of course, is that in reality, the world is probably somewhere between the red line and the blue line, right? If people anticipate some ability, right, some tax in the future. Okay, so what the model says is that the actual behavior will probably be depending on the beliefs. So I think kind of the first comment about this plot is that actually more important in terms of household beliefs is really what they think about the taxes and when it will arrive, as opposed to necessarily the risk of these hurricane arrivals per se. Okay. If you kind of look, if you kind of take these numbers seriously. So you can kind of calculate then, kind of the red line is like a competitive market pricing for these homes, blue is the planner, and then you can calculate then, if you also allow for some anticipated arrival rate of taxes, you can then calculate the value and the actual value of capital with optimal taxation. So let me make a couple of other comments. So I'm going to try to relate this. So Jose Shankman and Andrew Coley and I have published a climate finance issue, and I think several of the papers were exactly about housing prices and climate risk. Okay, so I want to use this model to clarify a little bit of the results in some of those papers. So typically, my understanding of the papers, at least sort of I edited, is that the regressions trying to link home prices to sea level rise have typically given very muted results. I think that is consistent with our model in the sense that you could say that that's consistent with this Q right here, right? That unless you thought there was going to be a huge amount of unless psi was going to be really, really big, right? For reasonable values, this is sort of what you're getting. And even if you impose a tax, which is what a lot of people talk about, the effects are still not going to be enormous because basically, even if you go from a 0 to a 1, you're talking about the max price effect is something like 8%. Exactly because there's a lot of offsetting benefits, right? So, detecting 8%, I'm not sure exactly is doable, but I think the model offers some guidance in thinking about what ballpark numbers we should be really getting when we run these regressions to begin with. Right? Okay, I think so the papers I think are very mixed. I think nobody's getting a very strong price effect, even though the New York Times keeps wanting to publish papers about how there's these mega price effects. But I'm not sure that if you write down like a fundamental model, you should be getting such huge price effects because there's a huge amount of benefits associated with mitigation. Okay, and then I'm going to close with I think kind of some comments from COVID. I think basically when Nung and I and Jin Chan started working this year, we started working on this paper we talked about, and then kind of COVID came, and then we sort of talked. We worked on a bunch of papers on COVID, and I thought that I learned quite a lot about having spent like really almost a whole year thinking about mitigating disasters, whether it's like a pandemic or like a hurricane. I'll kind of reflect a little bit and kind of say a few of the lessons that I felt like I learned. First, I think, of course, COVID's a bit easier because there's no 2-year fix for climate change. In 2 years, we're going to get a vaccine, and that's like a little bit like a climate moonshot, and then things are over, right? So in this paper we have in the RFS, we look at kind of optimal mitigation strategies by firms to minimize the damage of COVID on their earnings, just to keep their workers from being sick and whatnot. And sort of one of the things we learned is that, if the vaccine is very far away, people are much more aggressive in mitigation than if the vaccine were close, basically. Right? And then I think that sort of makes a lot of sense. I think there's like a similar parable that, if you will, for thinking about mitigation and climate change, in the sense that I think, the ability of emissions taxes, the ability of some technology to really control or reverse where we are in the climate, there's no 2-year fix, right? And this is kind of really, really far away. And so what that means, of course, is that we need to think a lot more about other types of investments we have to make in terms of mitigation, whether it's like seawalls and other things. Okay, I'll stop there. Thanks. Open up for questions.
Perfect. Let me first check with the panelists and see whether any of the panelists want to ask a question. So please raise your hand, and then we will ask you to unmute. Okay, so maybe I can go ahead to ask the first question where the others are still thinking about. What do you think about the belief heterogeneity when you try to make the decisions for the mitigation? So I think it applies to the disaster risk and also people's expectation about the risk from COVID and how much help they are going to get from vaccine.
Yeah. So I mean, I think the model obviously can talk to that in the sense that it's I mean, let me show the plot again. So the way I think to kind of talk about miscalibrated household beliefs, of course, is share the screen. You can just read off of this plot. Right. So you can read off of this plot the beliefs part, right? So the x-axis is pi, right? And you can imagine the real world is the world of science. Maybe pi is a 0.5, but everybody thinks pi is 0, right? That we're not in a bad state, right? That we think we're like pretty safe. This then going along these lines, depending on whether you're in a competitive market economy world or in a blue world, will give you basically the impact of miscalibrated household beliefs on home prices. So for instance, I think the typical narrative will be like, well, if everybody thinks pi is 0, but the world is like pi equals 1, how bad off are we in terms of mispricing? Well, this red line will tell you, right? In this model, it's actually not quite a lot. Now, of course, like I said, this is completely like just driven by EIS. Right? You can kind of make this thing bigger if you want. So I think in that sense, that's kind of one. Where we're back to sort of a little bit with these risk preferences. So depending on kind of the risk preferences you're getting, you can have pretty modest effects on home prices associated with miscalibrated beliefs, right? Now the other thing is really miscalibrated beliefs about, which I think of course are correlated, about taxes. Right, that you just may think that, so in other words, like you just may think, well, look, I know there's climate change, but the world will never be able to get their act together about ever implementing any type of policy, right? Exactly. That we're always going to stay on the red line. Okay, so if you basically now have policy disagreements about the extent to which these taxes can come, you can generate definitely more action. Right, so that would be something like, like I said, like 8% here, which is not trivial. I mean, I think it's not a small number, but it's also not like, what the model is basically trying to give you is a sense of what the magnitudes are, depending on, and of course you can pick your favorite parameters and get different magnitudes for that. Does that make sense? So that's the way I would.
Yeah, definitely. Yeah. All right. Are there any other questions from the panelists? And I see that there are some questions from the Q&A list, so let me try to pick. So Charlotte Glasser asked you about the correlated shocks from the increased disaster corruption due to climate change and the pandemics. So when the two type of disaster interact, how do we how do we interpret this?
Oh, I see. Interesting. No. So Charlotte, I think that's a good. So here I'll point you. Here I think in this model is only one disaster. Ian Martin and Pindyke have other papers where they entertain multiple disasters. When you have multiple disasters, there's some other trade-offs that one has to do. So I think that's kind of one answer is if we don't really have multiple disasters in our model, we only have one disaster in this model. But I think it sounds like the question is also just simply about in the data, right? To what extent the resilience of different countries in terms of mitigating these effects are correlated between like COVID versus kind of climate change. I think the model, this is not such a great model to talk about these sort of cross-sectional effects. I know that in the environmental literature, when you talk about mitigation, I think historically the literature has focused on the question of whether rich countries are better or have more ability to mitigate than poor countries. And I think that people believe there that is true, and that if you look at the impact of disasters, frequency of disasters don't really vary that much across countries, but of course the damages vary quite a bit per disaster, which I think people take to be some indirect evidence that poor countries are less able to mitigate compared to rich countries. I think it's a really interesting question. I mean, obviously this is not particularly you could interpret our model in that way if you do the following thing. So, beta 1 is the kind of the key parameter. You could say that, look, some countries are endowed with a better beta 1 than other countries, right? That would be able to generate some of the cross-sectional effects that you're talking about, right? That, maybe some countries that are less corrupt are more efficient at mitigating, right, per dollar compared to other countries. But I think kind of a more interesting model that you would have to integrate, I think, some other aspects which we haven't done into the paper, like, for instance, some financial constraints, and then talk about the relative importance of like a beta 1 effect, which is some type of endowment of technology effect, or some institutional, sometimes it's called institutional endowments of different countries versus some other kind of constraints that you might kind of model as well. Yeah.
All right, thank you very much, Harrison, for the interesting keynote speech. And this is the end of the session for today and also for the conference. So I would like to thank all the presenters, discussants, and audience for the wonderful work. And I will hand over to Bo for a concluding remark.
Thank you, Harrison. Thank you, Dong. Thank you, all the presenters and all the discussants and all the participants. This has been a great conference. We were very disappointed. When I say we, I mean the ECGI as well as the team in Stockholm, that we couldn't meet face to face, but this has worked incredibly well as a substitute. And it strikes me that there's a lot of interest in this topic. There's sort of a convergence of really rapid academic development. At the same time, the people outside academia are really interested in the topics. And the only time I can remember in my time in academia that I had that feeling was when I was a PhD student right after the internet bubble burst. when all of a sudden everybody was very interested in how people are not rational and what happens when people are not rational. And interesting observation is that Harrison was at the forefront of that development as well. Anyway, that was all I wanted to say. Thank you everybody for joining us, and I'm sure all the authors will look forward to hearing questions by email if you didn't have the chance to get a word in. And with that, I wish everybody a happy rest of the Sunday.
Thank you very much, Bo. Thank you.
Thank you.
Thank you both.
Thank you.